Let me call the meeting to order first and ask everyone to rise for the salute to the flag. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Rich, may we have a roll call?
Assemblywoman Rodriguez-Gray. Here. Assemblywoman Casagrande. Assemblyman Auth. Assemblyman Chitterelli. Here. Assemblyman O'Donnell. Here. Assemblyman Mukherjee. Here. Assemblyman Lagana. Here. Assemblyman Gusiora. Assemblyman Garcia. Assemblywoman Corride. Vice Chairwoman Lampett.
Here.
Chairman Coughlin.
Here. Okay, we have a few things to do today. There's just a couple of the bills have been held. Both after discussions and with the sponsors' requests. And if I had those numbers, I would tell you. Okay, that we're going to hold A566. And we are going to, the other bill's not even listed. Oh, no, here it is, yeah, A1274. Those two bills are going to get held. The good news is A4089, sponsored by me, is not going to be held. We got that going for us. Yeah, that's right. It is. Let me welcome Assemblyman Mukherjee, who's sitting in for Assemblyman McKeon. Welcome. Good to see you again. We also have a resolution, A70, but let's start with A4089.
Assembly Bill 4089 revises certain provisions of the Dental Service Corporation Act of 1968, including expanding the definition of covered dependent to include civil, union, and domestic partners, clarifying the circumstances under which dental service corporations are not obligated to accept participating dentists, and revising certain requirements for dental service corporations to provide information to the Department of Banking Insurance upon request. There are amendments offered to Assembly 4089. Those amendments have been distributed. They make technical changes to Section 6 of the bill regarding the policyholders to whom group contracts can be issued.
And those changes, just for everyone's edification, came from Dobie. So they're just some technical changes. The bill is really a cleanup bill. It has the support of stakeholders, and so I only have one card. Doug Sanborn, Delta Dental of New Jersey. Doug, did you want to say anything? You had indicated you would testify if necessary, but... Okay, thank you very much. Are there any questions or comments from the committee? If not, let me point out that there are fine co-sponsorships available. If you're interested. And I'll take a motion.
On the amendments.
First on the amendment. A motion on the amendments.
On the amendments to A4089, Assemblywoman Rodriguez-Gray.
Yes.
Assemblywoman Casagrande. Assemblyman Auth. Yes. Assemblyman O'Donnell.
Yes.
Assemblyman Chitterelli.
Yes.
Assemblyman Mukherjee.
Yes.
Assemblyman Lagana.
Yes.
Assemblyman Gusiora.
Yes.
Assemblyman Garcia. Assemblywoman Corride.
Yes.
Vice Chairwoman Lampett.
Yes.
Chairman Coughlin.
Yes. And now a motion on the bill is amended.
On A4089 as amended, Assemblywoman Rodriguez-Gray.
Yes.
Assemblywoman Casagrande. Assemblyman Auth.
Yes.
Assemblyman O'Donnell.
Yes.
Assemblyman Chitterelli.
Yes.
Assemblyman Mukherjee.
Yes.
Assemblyman Lagana. Assemblyman Gusiora. Yes. Assemblyman Garcia. Assemblywoman Corride.
Yes.
Vice Chairwoman Lampett.
Yes.
Chairman Coughlin.
Yes, the bill is released. Next for consideration, AR 70. I don't see Assemblyman Benson. So.
Oh, boy.
Let's read it.
Assembly Resolution 70 respectfully memorializes the Congress and President of the United States to take all appropriate legislative and regulatory action necessary to increase subsidies for premiums paid for flood insurance through the National Flood Insurance Program, especially for property owners who have suffered frequent losses.
Thank you. May I have a motion? Perhaps Assemblyman Gusiora?
On Assembly Resolution 70, Assemblywoman Rodriguez-Gregg, Assemblywoman Casagrande, Assemblyman Auth, Assemblyman O'Donnell, Assemblyman Cheddarelli, Assemblyman Mukherjee, Assemblyman Lagana, Assemblyman Gusiora, Assemblyman Garcia, Assemblywoman Corride, Vice Chairwoman Lampett,
Yes.
Chairman Coughlin.
Yes, the resolution is released. Okay, now that we get to the meat of the hearing today, and that is for the purposes of taking up the concept of digital currency. It's something that I find to be fascinating. It's a growing industry. It's becoming widespread and with uses and applications probably still to be developed and considered. But it's something that, as of now, is only beginning in terms of being considered for regulation. New York, I think, will pass some regulations today, if I'm not mistaken. But we have it's an interesting topic, and I think it's something that the committee will benefit from having an understanding for, and as we go forward, we'll consider whether we ought to be regulating, and if so, where and how. So let me first compliment the staff, Mark and Dan, for putting together what I consider to be a really distinguished panel of witnesses here today, and thank them for coming. As I said, this is really an issue that we're going to be ahead of. It's an issue that will be one that we probably talk about for a long time to come. So, that said, let me first ask Jerry Brito to come forward. He's the Executive Director for Coin Center. And Mr. Brito, thank you very much for coming. If you have written, and this is true for everyone, what I ask in this committee on a regular basis is if you have prepared testimony, if you could submit that to us. We're all really good readers, so we don't need you to read it to us. What would be most beneficial is if you could summarize it, and then what I hope and I suspect we'll have, because it's really, I think, the hallmark of this committee is that there's a very thoughtful and considered and respectful discussion that goes on. And so to the extent that you can avoid reading, that would be appreciated. And if you can't avoid reading, I'll feel free to remind you that you're supposed to be not reading as we go through. If everyone here is skilled and testified, we certainly give a little more room to people who might come and who have not or not generally testifying. But to each of you, I would appreciate if we could get on with the discussion, because I think it'll be really helpful for the committee, and it'll give each of you a chance to show us just how much you really know. So, that said, Mr. Brito, thank you very much.
Well, thanks for having me.
My pleasure.
Well, Mr. Chairman, members of the committee, my name is Jerry Brito, and I'm Executive Director of Coin Center. Coin Center is a nonprofit educational, public policy, and advocacy center, and our mission is to be an informational resource for policymakers and the media to help you all understand what digital currencies are, their potential, their challenges. We do that by engaging in briefings and testimony like this right here, by engaging experts and academics to develop public policy papers and other studies, and by engaging in advocacy when it's necessary. So I thought today what I'd do is give some background on this technology that we're discussing, explain some of the regulatory activity at the federal level, and answer any questions that you might have. So we're here to talk about Bitcoin, which is the world's first cryptocurrency. And what that means is that Bitcoin is the world's first completely decentralized digital currency. Digital currency is nothing new. We've had digital currencies for decades. If you think about Microsoft points or Facebook credits or World of Warcraft gold or even airline miles, these are digital currencies that have existed for a very long time. So what is it about Bitcoin and cryptocurrencies like it that make them unique? It's a decentralized piece, right? So Bitcoin is the world's first completely decentralized digital currency. And what that means is that there is no issuer of these currencies. There's no company behind them. There is no building or president or even a server of Bitcoin or of any of these cryptocurrencies. They are peer-to-peer systems. And so what does this mean? It means that this is essentially, for the first time, we have online cash. And that was not possible before the invention of Bitcoin. So let me try to explain this. If you think about cash in the physical world, you only need two parties to a transaction. If I take out a $100 bill and I hand it to you, now you have it and now I don't. And that is a transaction that only takes two parties. Before the invention of Bitcoin, for two parties to transact online or electronically, always required there to be a trusted third party between them. So somebody like PayPal or a bank or somebody like Facebook. And why is it that we needed this? We needed this because what would a cash-like transaction look online without a third party? Well, if you think about cash being something like an electronic file, you could have a $100 digital file, and I would send that to you in a message somehow, perhaps a lot like I would attach a Word document to an email. I would send that to you. Now, if you think about attaching a Word document to an email and sending it, if I send you a Word document, you now have it, but is it deleted from my computer? No. I retain a perfect electronic copy, perfect digital copy of that same document. And so as a result, if we were talking about money, and I sent you a digital representation of money, I would retain a perfect copy. And that would allow me to spend that same money a second time, a third time, a fourth time. So the way that we solve that is by employing a third party, somebody like PayPal. And what somebody like PayPal would do is that they would keep a ledger. They would keep a ledger of all transactions, of all customer balances. And so if I wanted to send you money, I would have an account with PayPal, and I would trust PayPal, and you would have an account with PayPal, and you would trust them. And so when I wanted to send you money, I wouldn't send money to you. I wouldn't send a message to you. I would send a message to PayPal saying, please deduct $100 from my account and add it to the other person's. And that's what would happen. But you always needed that centralized third party to avoid the double spending. What Bitcoin does for the first time is allow person-to-person transactions without the need for a third party, right? And the way it does this is that there is still a ledger. There is a public ledger called a blockchain, which records every transaction that happens in the economy, but there is no third party that keeps that ledger. That ledger is distributed in a peer-to-peer fashion among all the users of the technology. And so in this way, you can have truly, for the first time, online cash. And this has many potential benefits. In many ways, it's cheaper, it's faster than many traditional payment methods, and it allows for different kinds of transactions that weren't previously possible, things like micropayments. If you think about if a newspaper wanted to charge you 5 cents to read an article, today that's impossible because the transaction fees of using a credit card to pay for 5 cents would make it inefficient to charge that using a credit card. So something like Bitcoin makes that possible for the first time. It also allows for things like self-executing contracts and other innovations. Now, to date, Bitcoins have represented money at a floating exchange rate. But if there's no reason why Bitcoin has to represent money. If you conceive of Bitcoin simply as a token and the Bitcoin system as a ledger system that allows you to transfer these tokens, well, if you conceive of it that way, you can imagine that a Bitcoin can represent a house or a car or a share of stock or an ounce of gold. So this opens up the possibility of having distributed, perfectly reconciled, decentralized ledgers for the first time. And Bitcoin is therefore an open platform for innovation. Nobody owns it. It's open source. It is open for anybody to build upon. And so as a result, it's a lot like the internet, right? And Bitcoin today looks very much like the internet did in 1995, right? Then some dismissed the internet as a curiosity, but many could see that because it was an open platform, you could build on top of it. And you maybe couldn't imagine what you could build on top of it. In 1995, we couldn't imagine Skype or Netflix or Facebook, but we could see that the pieces were there to build something new because it was open. And Bitcoin is a lot like that today. We can't conceive of yet what that killer application is, but we see the pieces there to build something. And some of the folks I think who will be testifying today are trying to build some of those things. Bitcoin faces some challenges, however, and chief among those is regulatory uncertainty, especially at the state level. And again, if we think back to the early internet, it was not until the government made it clear that it would pursue a light touch regulatory approach that internet innovation really took off. And Bitcoin today is in need of a similar commitment from government. I think we're starting to see some of that at the federal level. I think some of my colleagues here today are going to go over what the states have been doing and how the states have been approaching it. So I'm going to focus on the federal level. At the federal level, the approach has been one of taking time to understand the technology, of issuing guidance on how to comply with existing law and regulation before issuing new regulation, and forbearing from additional regulation that might hamper innovation. So the first and most active regulator at the federal level has been FinCEN, which is the Financial Crimes Enforcement Network of the Treasury Department. That's the agency that administers the Bank Secrecy Act. They're concerned about money laundering and terrorist financing. And they issued guidance in March of 2013 that requires virtual currency exchanges and other businesses, though not consumers or merchants, to register with FinCEN as a money service business, to comply with Bank Secrecy Act regulations, including know your customer rules, anti-money laundering suspicious activity reporting. And to date, the companies that are in the space have been complying. They have been registering, they have been submitting suspicious activity reports, and FinCEN to date has expressed that they're happy with how the industry has been fulfilling their obligations. There's still some pieces that need to be worked out, but generally that's been the approach. Aside from FinCEN, there have been other agencies that have taken some initial steps. So, for example, you have the IRS. The IRS has provided guidance on tax treatment. You have the Consumer Financial Protection Bureau, the CFTC, the Consumer Commodities Futures Trading Commission, which has indicated that while Bitcoin probably is a commodity, the commission really has no reason to regulate here because it's concerned about commodities futures, not commodity trading itself. And there's no evidence of market manipulation in the market, so it's not really involved. The CFTC, however, has approved Bitcoin derivative exchanges, and I think we'll hear from some of those later in the panel. And finally, you have the SEC, the Securities and Exchange Commission, which mainly has engaged in enforcement to deal with some scams, some schemes that have emerged around this new technology. Those schemes often emerge around different new technologies that basically are Ponzi schemes where people are asked to invest Bitcoin, essentially money, into a scheme that promises outsized returns. The SEC hasn't been engaged in enforcement actions against those folks, but the SEC really has not seen Bitcoin to date as a security itself, and so it really has not looked into any regulation just yet. So if Coin Center, could offer you two guiding principles to use when you're considering policy related to Bitcoin, they would be clarity and innovation. Right? Clarity in terms of how existing regulations would apply to this new technology, setting out rules of the road for Bitcoin companies seeking to operate in New Jersey, making sure that these companies understand that if they want to do business here, how do the existing laws apply? And second, it's to always measure new policies against the impact that they might have on continued innovation. This technology, again, we don't know where it's going, but there are many positive uses, and we want to make sure that those can meet their potential. So if you need any further assistance as you consider digital currencies, please don't hesitate to contact Coin Center. Our mission is to build a better understanding of these technologies and to promote a regulatory climate that preserves the freedom to innovate around these technologies. And we're more than happy to connect you with the appropriate academics, experts, and practitioners in the area. So with that, thank you, and I'll be happy to answer any questions you might have.
Thank you, Jerry, and I appreciate the conciseness of your testimony. Just, to start off, how is the originating investment done to create a Bitcoin? So there has to be some originating fund somewhere where there's a transaction to create the value of a Bitcoin. Also, in doing some reading, a Bitcoin doesn't always equal a Bitcoin. A Bitcoin can equal a different value. And is the value of a Bitcoin, can it ever change in terms of the value of your investment into a Bitcoin? And my third question has to do with internet gambling in New Jersey. And we know that Las Vegas has done some Bitcoin transactions. How do you think it's going to impact New Jersey with internet gaming?
Okay, good questions. Let me take the second question first, which is about the value of a Bitcoin. So one Bitcoin is certainly always going to be equal to another Bitcoin. One Bitcoin is one Bitcoin. What does change, however, is the exchange rate between a Bitcoin and the dollar value or the euro value, et cetera. And that is a floating exchange rate. It's a market rate, the same way that there is a floating exchange rate between the US dollar and the euro or the yen. If you think about, you're going to France, you take some dollars, you buy some euros at an exchange rate, you come back, that exchange rate is probably different. Bitcoin is the same way. Bitcoin's exchange rate is much more volatile than a traditional fiat currency. The reasons for that is, there are many reasons, but largely is that it's a very illiquid market to this point. There are very few hedging instruments that would help stabilize, and there is no monetary authority, like a central bank, that could help, that would exist to stabilize that currency. That said, we're seeing more liquidity coming to the market. We are seeing new hedging instruments emerge. So I suspect that the volatility will subside with time. I don't think it will ever be as non-volatile as a currency that has a central bank that exists to keep that currency stable. But it'll be a lot like gold, let's say. Gold is a commodity that's volatile, but it serves many different purposes. And I think that Bitcoin, although it will always retain some volatility, will serve many different purposes. As far as the original value of a Bitcoin, I can tell you where Bitcoins come from, but the original value of those Bitcoins, again, is set at a market rate. The first set of Bitcoins, what was their value? It was whatever. At first, they were zero, right? Because if I said to you in 2009, when the first Bitcoins were mined, how much money will you give me for these entries in a peer-to-peer ledger? You would say nothing. But eventually, people began to see that there was value in these entries and would now pay 10 cents, and then it became $1. And so it's just a market process by which value has been assigned to these units called Bitcoin. Where do they come from? It's a little difficult to explain in a concise format, but essentially you have an algorithm that backs the peer-to-peer system, and everybody who is part of the system agrees that there will only ever be 21 million Bitcoins in circulation. To date, like right now, there exist 13 million Bitcoins. Each 10 minutes, 25 new Bitcoins are introduced into the Bitcoin money supply. When I say they're introduced, again, there is no central issuer, so there's no one company that is choosing to introduce these Bitcoin. It is a consensus process among all of the users of Bitcoin that when new entries are added to the Bitcoin ledger, which happens every 10 minutes, there's a new entry in that ledger creating 25 new Bitcoins. And when Bitcoin first began, this is getting a little technical, but when Bitcoin first began in 2009, it was 50 new Bitcoins every 10 minutes. That number halves every 4 years. So in 2013, that halved to 25 new Bitcoins every 10 minutes. This is where we are today. That number will halve again in 2017 to 12.5 and continue to halve until we get to 21 million Bitcoins, and there will not be any more. I hope that answers your questions.
Trying to figure out how.
Sure.
You're being very concise, and I appreciate that. But I want to get a Bitcoin.
Yes.
How do I get a Bitcoin?
The easiest way for a consumer to acquire Bitcoin, say you want to spend it at Microsoft.com or Dell or Expedia, which are companies that accept Bitcoin, you would go to an exchange. You would go to somewhere like Coinbase or Circle or Itbit. These are exchanges where, a lot like PayPal, you open an account, you connect your bank account, you transfer over $100, however much you want, and you exchange. Now you have Bitcoin. What's that exchange rate? It's a market rate.
There is an originating transaction whereby
Yes.
a name is associated to a dollar
I see what
value.
you're saying.
Yeah.
There's definitely there can definitely be points of intersection between a traditional financial system and Bitcoin. And companies like these exchanges that I've mentioned, they do know your customer, and so as a result, they do keep a record of the identity of the person who is acquiring Bitcoin. Absolutely.
Okay. And then the obviously the gambling issue, but will there, just to add another question, will there ever be some company that will only accept Bitcoins?
That will only accept Bitcoin for payments? There are some today. So today, most companies that accept Bitcoin for payments are just typical companies that accept credit cards and PayPal, and then they're just adding a new payment method that their consumers have been demanding. So Dell, Microsoft, Overstock.com. Now, there are some companies who are on the bleeding edge who only accept Bitcoin. And the reason they do this is the following. They offer consumers cheaper prices as a result of only accepting Bitcoin. Let me explain how this works. So if I am an online retailer, let's say I'm Amazon.com, and I accept credit card payments, the credit card company charges me a transaction fee for accepting payments. Usually that can be 3% of the total transaction amount. With Bitcoin, that transaction fee is about 1% or less. So a merchant can accept Bitcoin payment and pass the savings to the consumer. So you see some online retailers that only accept Bitcoin, and as a result, the prices of their products are cheaper than you might find elsewhere. As for the gambling question, it's not something I've really looked at too closely. I know that simply the gambling enterprises are always on the lookout for new ways to receive payment. One thing that I think is especially interesting to gaming companies is that Bitcoin transactions can be irreversible. So if you think about a credit card, if I make a transaction and I'm not happy with that transaction, I can always call the credit card company and say I'm not happy, and they will reverse the transaction. And the merchant, in this case it might be a gaming company, would be out the money, even after they've paid out or whatever. With Bitcoin, you can have reversibility, but by default, Bitcoin is irreversible because Bitcoin is like cash. Once you hand over a $100 bill, there's no third party you can call to reverse that transaction. So gaming companies who are very concerned about reversing transactions, and in fact, it's not just gaming companies, it's any number of online retailers who are worried about what's called chargeback fraud. They ship out the goods, and then the transaction is canceled, and they're out the goods plus a penalty to the credit card company. That is attractive to merchants who are concerned about that kind of chargeback fraud. Sure.
Senator Chitterelli, I guess. First.
Thank you, Mr. Chairman. And thank you, Vice Chair, for teeing it up for me. When she buys the Bitcoin,
Yes.
who's getting that money?
Seller of the Bitcoin.
Seller. Okay. Currently, Kevin Logan here was kind enough to show me a graph on his iPhone. 1 year ago, the U.S. dollar value of one Bitcoin spiked seemingly overnight to $1,200. Mm-hmm. It's currently at $220.
Mm-hmm.
What caused the spike? What caused the steady decline over the past year? And were consumers is screwed an appropriate word? In committee, Jason? Jason's giving me the eyebrow. Okay, buddy. Yeah. Were consumers inadvertently
Affected.
Affected. Thank you. Better
Sure.
soon. Yeah.
So if you think about the timeline of Bitcoin. Bitcoin began in 2009, January of 2009. And at that point, Bitcoins were worth pennies. So if you were somebody who invested in Bitcoin then, even today at $200, you're doing very well. So I just want to point that out, that some consumers did very well. But what caused the spike? I think what caused the spike is increasing interest in Bitcoin. It's an increasing realization by the part of investors and just others who are paying attention that this is a system that potentially is going to be a global payment system.
Okay, if I may.
Yes.
That kind of interest, intrigue, curiosity, and uptake is usually associated with a bar graph that does this. I mean, 1 year ago, it's not even a hockey stick. It is a 90-degree angle.
Okay, yes.
Which suggests, and I'm not cynical by nature,
Yeah.
manipulation.
Okay.
So let me be transparent where
Yeah.
my question's coming from.
Yeah.
Because I applaud the chairman for what he's doing here today by having us have this discussion. It's very timely, it's very important, it's relevant. But you know what our job is, right? It's to let the market be efficient through freedoms, but at the end of the day, protect the consumer.
Absolutely. So I think that the hockey stick graph that you're seeing is very similar to the early Internet. If you looked at the valuations of early Internet companies, they look like hockey sticks. And if you looked at the valuations of something that is comparable to a Bitcoin would be a domain name, so like Amazon.com. There's only one of those in a registry, and the value of some of those is like a hockey stick. In particular, I think if you want to get to specific things that caused that rise 1 year ago, it was things like China. The government of China put forward some favorable news about the treatment, and so you saw a lot of investment from China, so a lot of Chinese investors coming into the market, a lot of liquidity from China coming in. I think you saw in November of 2013, which is about just leading up to that height, the U.S. Senate held hearings on Bitcoin, at which I happened to testify, that were seen as very, very, very positive for Bitcoin because it was a signal that the U.S. government, and at that hearing, for example, Department of Homeland Security and DOJ all expressed that this was a system that, while it could be challenging to law enforcement in some respects, serves many useful, legitimate purposes. And so that signal, I think, triggered a lot of that rise. What's made it decline over the past year, I think, is a correction. That's my personal opinion. I think it's been a correction. I think it probably overshot. The enthusiasm overshot, and it's been correcting ever since. And there have been different news events that drive that. Now, that all said, to your question about consumers, I think is very key because that's ultimately what we're interested in. I think the typical person who is acquiring Bitcoin and investing in Bitcoin is not your typical consumer. It's going to be a sophisticated person. And secondly, the Bitcoin market right now is incredibly tiny. It's
Incredibly
tiny. It's a couple $1 billion. I've spoken to folks at the Consumer Financial Protection Bureau, and they've expressed to me that something that they're looking at, they're keeping an eye on, but relative to some of the other consumer challenges that they're looking at, this is incredibly small. So, yes, I think that the fact that Bitcoin is volatile potentially could hurt a consumer that doesn't know what they're doing, which is why we need good disclosures, et cetera, and that's something I think the companies are doing, and we may see regulation from the CFPB at some point in the future addressing that. And finally, I would say this. You can use Bitcoin without being exposed to any of the volatility. If you're just a consumer that wants to make payments, you don't need to be exposed to the volatility. How does that work? And by the way, this works for merchants too. If you're a merchant today, let's say you're a dry cleaner and you want to accept Bitcoin, you would get an account, a merchant account, with a merchant processor like BitPay or Coinbase. And the way this would work is you would now accept Bitcoin. A consumer who wanted to pay with Bitcoin would come to your shop. You would ring them up, and you'd show them your Bitcoin address. The consumer would send Bitcoin to that address. At that moment, the merchant processor, BitPay or Coinbase, takes that Bitcoin, automatically converts it to the dollar amount at the current exchange rate, which is the amount that you rang them up, and deposits it into their account. So they face no currency risk. The consumer on the other end could use something called a dollar wallet. So Coinbase, for example, is a company that offers this. You deposit dollars into your account. Let's say you have a balance of $100. That value is $100. You have dollars in your account. You don't have Bitcoin. You get to the dry cleaners. You want to pay in Bitcoin because they're offering you a discount or for whatever other reason. At that moment, you hit pay. At that moment, they take the amount of dollars. So they're charging you $10. Take $10, convert it to Bitcoin, send. So you're not exposed to any of the volatility.
I'm going to have a little less sleep tonight, because of you, Mr. Chairman, but welcome to the Matrix.
You're and feel free to dream about me. Assemblyman Goussior had a question, but he left. Had to go. Okay. Assemblywoman Caridi.
You had just mentioned in the example where if they take $10 out, they pay $10. There's no conversion there?
There is. So
Okay.
the way it would work is, okay, let's say
The merchant gets his $10.
and you pay only $10. And in between, the rails were Bitcoin. But that's transparent, or that's invisible to you and the merchant. So let me try to explain. Let's say that I am a consumer with an account at Coinbase. Coinbase happens to be the largest wallet provider in the U.S. And you are a merchant, and you have a merchant account with BitPay, right, which is not a competitor of Coinbase. They're unrelated. When I come to your business, you ring me up and you'll say it'll be $10, and I say I'd like to pay in Bitcoin. At that point, you show me your Bitcoin address, which is like I take out my phone, I scan it. In my Coinbase account, I have $100, not Bitcoin. I have dollars. Those don't fluctuate in value. At that moment, when I scan that account, it says, okay, you're being charged $10. $10 are taken out. They are converted to Bitcoin. They're sent over the Bitcoin network to the merchant via BitPay, which is the merchant processor at the merchant that you use. BitPay gets that money at that moment, converts it back to dollars, puts it into your checking account. So dollars are taken out of my account, dollars went into your account, but in between, the rails that were used, the electronic rails, were Bitcoin.
For some reason, I misunderstood then. I thought that the exchange could impact the amount that was...
Yes. If I buy Bitcoin today, right, if I don't deposit dollars into my Coinbase account, but instead I buy Bitcoin. So I take $100, and let's say that one Bitcoin is worth $100. I buy Bitcoin, and now in my Coinbase wallet, I don't have $100, but I have one Bitcoin, which when I bought it was equivalent to $100. Tomorrow, it might be worth 90 or 110, right? So that's how it can change.
Can you pay that merchant with that Bitcoin
Sure.
without having dollars in your account?
Absolutely.
So then that Bitcoin that was $100, when they do the exchange...
Might be more, might be less.
Okay.
And so if you're a consumer that wants to avoid that volatility, avoid that risk, which could be positive risk or negative risk, you wouldn't buy a Bitcoin. You would simply hold dollars in a dollar wallet.
You had mentioned that the ledger, is everyone available to that ledger? Like that one ledger that has all the accounting, anyone that's in that Bitcoin
It's
group
public.
can see it?
It's public, not just to folks who are part of the Bitcoin network, but it's public to anybody in the world.
So what does the ledger contain? Like name, how much you borrowed or how much you took, how much you spent?
Right.
Everything?
Right. So the Bitcoin ledger has a record of all transactions that have ever happened in the Bitcoin network and that are happening. And so that means the date, the time, the amount of the transaction. It does not include the identity of the person. Because, of course, if that was the case, that would be a big privacy concern. I could see what your salary is, what you've been spending money on, et cetera. So how do we solve that? So Bitcoin basically is a pseudonymous system, meaning that there are Bitcoin addresses, which are essentially like a random string of letters and numbers. That's like your account is one way to think about it. And so you can see from this address to this address, this amount at this time. And so that's not anonymous, that's pseudonymous. So the way I like to explain it is if you think about cash Cash is a completely anonymous payment system. If I go to the market, to the farmer's market, and I meet a stranger who I don't know, and they're selling me tomatoes, and I give them money, give them cash, and we part our separate ways, that's a completely anonymous transaction. I don't know their name, they don't know my name, no record kept of the amount, the date, the time, completely anonymous. On the other end of the spectrum, we have credit cards. Credit cards are perfectly identified. The credit card company knows my name and information, the merchant's name and information, and there's a record kept of the date, the time, the amount, sometimes even the purpose, perfectly identified. Bitcoin is in the middle, in between the anonymous and a perfectly identified, because there is a perfect record kept of every transaction, and we see it going from this address to this address. But what is the identity of the person behind this address? We don't necessarily know. So a company that is compliant with the Bank Secrecy Act, that is exchanging money, will know, because they are required to know the identity of their customer. And so if a law enforcement agent, say, needed to know who was a party to this transaction, they can subpoena that company. And as we saw just yesterday, the person who started a black market online called Silk Road was convicted partly using evidence in the blockchain, right? So the FBI was able to prove that Bitcoins that were used as proceeds of illegal activity were his and were, tied to him.
Chairman, if I may, when you say you buy from the seller is anyone that has coins that is part of this community?
It's not a community, I would say.
whatever you want to refer
It's
to it.
just anybody who has Bitcoin. But typically, who you would get, the seller would probably an exchange, somebody like Coinbase or Circle. So you could go to a broker like that and just buy Bitcoin. Or you could go to a more traditional exchange where they're setting up bids and asks and matching it.
And when you buy it, there's like a fee on top of, like you want to exchange or you want to get, say, $100 worth of Bitcoins, and then there's a fee on top of that to get the,
Yes.
for whoever's selling it to you.
It's just like currency exchange, like you would buy euros at the airport. There's a fee attached to it. So with companies like Coinbase Circle, I think it's about 1%. So
Is there any protection for the consumer who's buying the Bitcoins that they know, like if, you know how the banks have insurance?
yes.
Is there any kind of protection here?
Right. So banks are federally insured. These companies are not federally insured. FDIC insurance is only available to banks, so they're not federally insured. But the major Bitcoin exchanges, companies, again, as I've mentioned, Coinbase, Circle, et cetera, they have insurance that they've acquired privately, and they disclose that to their consumers.
Thank you, Mr. Chairman. And I do commend you because this is the wave of the future. My concern is, what's the protocol being used to validate the transaction, and what are the protections to ensure that there are no cyber threats in manipulating the blockchain?
Right. So this is where it gets complicated, and it's the sort of thing that, if you don't mind, I will submit to you some written explanations that will take longer, and we'll go through the math of it. But basically, it's cryptographically secure. Using the same cryptography that we use to secure our banking, et cetera, the system employs a set of verifiers, right? And so anybody who contributes their computing capacity to solving cryptographic problems that ensures that the transactions being made have not been previously, it's not money that's been previously spent, and thus verifying transaction and adding them to the ledger, they do this computational work, and it cryptographically is verifiable, and it cannot be altered. So
Thank you, Chairman. When we eventually develop regulations, how should we treat Bitcoin? Like a commodity, currency, property? I mean, what are your recommendations?
So I think you have to ask yourself, in what context are you regulating? And so then you have to look at it. I think there are very few contexts, and again, I'm not an expert. I think others are going to talk about the state level regulation. But I think there are very few contexts in which the state is going to be concerned about Bitcoin as a commodity or as a security, et cetera. I think where states are most active is in money transmission, right? So money transmission is something that states regulate. And so as a result, if you are a exchanger, if you are a merchant, or if you are sending Bitcoin on behalf of another person, you're acting as a money transmitter. And money transmitters need money transmitter licenses from the relevant agency of the state. And so there, what I would suggest is to make it as clear, as consistent with other states as you can. I know that the Conference of State Bank Supervisors is developing a model framework for states to consider, because what ends up happening is that entrepreneurs who are developing new businesses need to get a license from each of every state in which they do business. And to the extent that these are all differing, this can add quite a bit of burden. So to the extent that they're consistent, to the extent that you can apply for many at the same time, and to the extent that they are clear, to the extent that they can take into account that there are differences in the ability to not to comply, but to devote resources to compliance from, let's say, a Fortune 500 company versus a startup that might be, a few folks with some seed investment. Taking those considerations, I think, is what's important.
Vice Chair Lampert.
I just have two more, hopefully quick questions. So down in D.C., they're talking about making the Internet a utility and regulating it by utilities. Obviously, Bitcoin is via the Internet. Have you had any sort of discussions about that aspect of what the future might hold? And my second question is so, we're all down over here sort of, Googling and everything else. Mm-hmm. So can you speak to the Mt. Gox issue of the $480 billion, I guess, or they owned 70% of Bitcoin at one point in time, and now, by 4 years later, they were obviously bankrupt, and obviously that was a severe blow to the Bitcoin world, and can you explain, that aspect of the issues of bankruptcy?
Sure. So, what's that? Oh no, these are fine. So the first question is utility regulation of the Internet, something known as net neutrality. That really does not affect the Bitcoin issue at all. That is about, that's really a competition issue facing last mile providers of broadband and whether they can charge more or less or block different content. Potentially could be some implications in the future, but it's very tangential. So I don't think there's any implication there. I'm happy to answer any specific questions. As far as Mt. Gox, so Mt. Gox was an exchange. In fact, it was the first really big Bitcoin exchange where you could go and exchange dollars or euros, fiat currency, for Bitcoin. Mt. Gox, so again, if you think of just really revolutionary technological innovations, things like the Internet or the personal computer, where do they begin? They begin in people's garages. They are begun by sort of people who think differently, misfits, the crazy ones, as Steve Jobs would say. And they began these revolutions. If you think about, again, the computer revolution, it's Steve Jobs, Steve Wozniak in his garage. The Internet, it was grad students. And they take the technology to a certain point. At a certain point, they graduate or they don't. Somebody, I think Steve Jobs had the capacity to graduate and turn Apple into what it is. If it had just been Steve Wozniak, I don't know if we'd be here. Oftentimes, others come along who take the technology to the next step. Folks who have more experience, a greater capacity. So when you think about Bitcoin, it began in 2009, and it began really around cryptographers, computer scientists, eventually enthusiasts, and they were trading Bitcoin back and forth for pennies. And it was just this cool thing that they're like, wow, this works as cash. And slowly people began to pay attention. More enthusiasts came in. Somebody came along and said, wouldn't it be cool to have a website where you can exchange fiat for Bitcoin. And so they created the site, but they were not prepared that for this to become a billion-dollar industry essentially overnight. And when they got there, they found themselves totally unprepared. The website that they had built was not really up to snuff. And something happened. Part of it is we don't know exactly what happened, if they were hacked or if it was an inside job. This is an investigation that's ongoing, and I think we'll see either law enforcement in the U.S. or in Japan, where Mt. Gox was based, to take action eventually. It's certainly a possibility. So the point is that exchange collapsed because people's Bitcoins went missing, and it went away. And that's a very unfortunate event, but that should not keep us from thinking that it can't be done well. And so today what you see are very serious entrepreneurs with experience in the finance industry, with experience building big startups in Silicon Valley, from Facebook to the rest. You have serious venture capitalists from Andreessen Horowitz, Union Square Ventures, Union City Ventures. These are all serious venture capitalists who are coming in, backing serious entrepreneurs to build real businesses that we can trust. And so I wouldn't let Mt. Gox, hopefully Mt. Gox won't get in the way of believing that this can be made to work. And I think you'll have on the panel some of these entrepreneurs who are building these companies.
Senator North.
Thank you. My colleague mentioned Mt. Gox, and so I'm not going to ask you about that. But a thought occurred to me, and I guess I'm anachronistic. What I'm going to mention to you happened probably before the home computer and everything else. But there was a little pyramid scheme that was circulating around back when I was a young guy, and it was called Airplane.
Senator, I'm sorry, I don't mean to cut you off, but just anyone who is interested, I forgot to mention earlier, Freeholder Liz Moyo is being sworn in now as the new assembly person from the 15th Legislative District. If anybody wanted to go down, I'm sure that's where Assemblyman Gusiora went. But I just wanted to remind everybody of that. I apologize.
No problem. Thank you. And the premise of it was this pyramid. There was someone at the top, and all these other people would put money in, and it would go up to the top, and they were constantly seeking new members to the bottom to funnel the money up. And eventually the thing collapses. So can you describe for me the difference? Because you're telling me that they started at virtually nothing, or a nominal fee. I remember reading that in an article, a nickel or something like that. So the thing goes for a little while. It starts to blow up, and the originators just move, they change it to another name, maybe they'll call it Airplane, and they start the process all over again. Can you explain to me the difference between what I've suggested to you and what it is that's going on? I'm sure you have rational explanation, but I'm just, I'm a slow thinker, so help me out, okay?
Sure. So I would kind of, I would ask it this way. What is the difference between the pyramid scheme that you described and something like gold? And there really is very little different, except that some people believe that gold has intrinsic value, right? Basically, it's got a longer time span. Something like Bitcoin, I think, is a new type of gold in the following sense. It is a asset that is scarce, right? It is limited in quantity, and it has some intrinsic value. In this case, it is that you can make online payments between two persons without the use of an intermediary, and that is completely new. So what's the difference? The difference is that the pyramid scheme that you describe had no purpose besides simply increasing the number of people getting in to hopefully make people get richer before it collapses. Bitcoin is a revolution it's a revolutionary breakthrough. Whatever else you may think about it, it is absolutely a revolutionary breakthrough in computer science that for the first time allows two persons to transact online without the use of an intermediary. That is something that computer scientists have been working on for decades, and this solves it. That has value, and as a result, people are putting their money in, not in a way to just make more money with nothing really at the end of it. No, they're investing in a technology and an ecosystem that, when built out, will allow for efficient global payments. So it's very different, I would say.
So we have to assume that the hierarchy of the fabricators of this system are altruistic or over and above board, because they're really not regulated in any way right now, are they?
No, you don't have to assume that. Simply because this technology exists. That's a fact. This technology has this breakthrough that I described. That's a fact. And this was created. The originators of this technology probably have profited as a result of launching the system. So whether they're altruistic or not really doesn't matter. You could either think as, well, they've earned a lot of money as a result of their invention, which is really, again, quite astounding. You can ask any computer scientist, and they think it's something that deserves reward. Or you could think of it as it is altruistic. Their motivation really doesn't matter because the technology exists and it's out in the world and it's open source.
As long as it's not nefarious, their motivation, right?
No, because the system is open source. Open source means that the code is completely viewable and reviewable by anybody. As a result, cryptographers and computer scientists around the world have looked at this code, and there's nothing in it that they can detect as nefarious or otherwise having something that could spring up or steal the bitcoins or anything like that. The system is, so two things, right? So number one, part of the invention is the code itself that powers the system. The other piece of the invention is the insight about how you solve the double spending problem, this computer science problem that has vexed computer scientists for decades. So that's just knowledge that's out in the world now. We now have solved this problem. We understand how that works. Nothing nefarious about that. And as far as the network and the system itself, it's completely reviewable. It has been reviewed, and there's nothing nefarious in it. So whether their motivations were, boy, I want to launch a new currency in order to collapse the U.S. dollar, it doesn't matter what their motivation was. The system exists. We can look at it, and we can sort of figure out what are its advantages, what are its potentials, what are the challenges that it poses for different pieces. It exists, and it's a good thing.
So you mentioned that, what was the amount, the finite amount of
21 million Bitcoin.
21 million.
Bitcoins, however, are divisible to 8 decimal places, so you can transact in 1/millionth of a Bitcoin. And if you take these as sort of the base token, you have trillions of Bitcoins, which account for more currency units than we have in the world today.
What prevents them from adding more?
From
Adding more than 21?
who's they? Exactly.
Whatever the authority
Exactly.
is.
That's the beauty
There's no
of it.
central bank, obviously,
Exactly.
a worldwide banking
Exactly.
system.
What prevents it is that there is no they that can add more. It's a consensus-based system, so it would have to be everybody who uses Bitcoin. Potentially, I would hazard to say 10 years from now, perhaps everybody here and everybody else who uses Bitcoin would have to agree that we want to add more. And so then it would just be a consensus decision. Right now, I don't think you could get that consensus, and I doubt you would ever get that consensus. Partly because the value of Bitcoin is in its scarcity.
Let me just back up. When I mentioned they, I guess I used the wrong word. How about the originators?
Good question. Good question. Again, because this is a peer-to-peer system that has been launched in the world, the originators no longer have any control, and we can. There is nobody. Again, there's nobody in control. They invented the system. The originators invented the system, but once it is launched, they have no power over controlling it.
Vexing, very vexing. Thank you so much for
My
your
pleasure.
answers. Thank you.
Any other questions? I have one. And it really goes to the who is the they, right? Every 10 minutes, 25 new Bitcoins
Yes.
are released. Who releases them?
So-
Where did they come from?
question.
What's the first cause,
Yeah.
right? It's kind of the age-old question
So-
of God
so-
versus creationism. What's the first cause? Who's the first
Okay.
particle?
So you have, to be part of the Bitcoin network, you simply need to download some software.
Right.
And once you download that software and you run it, you are a node in the network. And it's a peer-to-peer network, so you connect to other nodes in the network, other people just like you who are running the software. And at that point, you can broadcast transactions in the network. So say, I want to send this many Bitcoins that I own to this other person, and those transactions are broadcast. They're verified that other nodes look at it and say, yep, these coins have not previously been spent, so they are eligible to be included in the ledger. There are some special nodes, and anybody
But
can...
who holds those? There are exchanges, right?
No. So again, this is a decentralized
They
ledger.
exist in the universe.
Okay.
They come into existence by themselves?
Maybe let me back up and try to explain a different way. Bitcoins are ultimately, it's not a thing that you can hold and see, right? Bitcoins, it's a lot like electronic dollars.
Mm-hmm.
Bitcoins are ultimately entries in a ledger, right? So you have your Bitcoin address, and next to it it says 10, 10 Bitcoins. And so all Bitcoins are an entry in that ledger. What's that?
Nothing.
Oh, this ledger, typically when you have a ledger like this, there's a company, say PayPal, that keeps that ledger.
Right.
And they know who has what. With Bitcoin, there is no company, and so therefore this ledger is in each of all of our machines, all of our computers. We all share the same ledger. And what we work at, the process of verification, is making sure that all of our ledgers stay in sync. So as new transactions are added, all of our ledgers stay in sync. Every 10 minutes, a new block is added to the blockchain. That means that a new page is added to the ledger with all transactions that occurred over the last 10 minutes. You have, as I was mentioning before, there
But who gets the value?
Yep.
Who holds the value of those 25?
I'm getting there.
Okay, I'm sorry.
So the ledger has entries for all of us, right? And so who holds the value? Well, I hold the value to my Bitcoin, right? So there's an entry for me with how many Bitcoins I have, and only I can control those. But you're asking the new Bitcoins that are introduced.
At a moment in time, there
Yes.
are 13 million.
Yes.
At the next moment in
1325.
time. Right. Who
gets the 25?
Yeah.
Getting to that. And that is the following. You have a series of nodes that are known as miners. Essentially, mining is the worst name that could have been applied to the activity that these special nodes do. A better word for what they do is verification. They verify transactions. They perform the function that somebody like PayPal performs in a traditional system. Anybody can become a miner, right? All you have to do is download the special software and run it. You might need some special equipment because it is very computing intensive to verify transactions. If you are the miner that verifies the next block in the blockchain and adds the next page in the ledger, you have entries for all the transactions that happened over the last 10 minutes, and at the end there's an entry that says from nowhere to you 25 Bitcoin. So it is the miner who verifies transactions, who performs the PayPal-like function that gets that Bitcoin. And that is their reward. That's what incentivizes these verifiers to invest into the computing capacity.
Because the first one wins. First
Yes.
guy to get to that, to create
right.
that blockchain page is
Gets
the
the
holder
20.
of that, or gets to do
Correct.
Right.
Correct. And
So-
and every 10 minutes is somebody else.
How do they make money?
They make money in two ways. One way is getting that Bitcoin, right? Getting those 25 Bitcoins. They can then exchange that for fiat if they'd like, for dollars, and now they have dollars.
How do you do that? So I'm a
You go to an
merchant.
exchange.
Okay. And they'll send me a check
Yes.
in U.S. dollars or
Yes.
euros or
Correct.
yen or whatever
Correct.
I choose.
Correct.
Okay.
The other way that miners have two income streams. One is the reward fee, which is 25 new Bitcoin. But again, that continues to have. Eventually, there will be no new Bitcoins minted.
Right.
And so what incentive will verifiers, miners, have to continue performing this work? There are two income streams. One is that reward. The other income stream is fees. So when I send you some Bitcoin, I can optionally add a mining fee, and that incentivizes miners to take that transaction and include it in the next page in the ledger. So you have those fees. Those fees are variable.
then that fee's not controlled in any way.
No, it's market.
Because I don't have to take it. I don't have to take
No.
those Bitcoin.
Correct. And so basically it's a market rate. And it's right now it's like pennies.
Okay. Yeah, okay. One last question, and then we're going to, because by my account, we'll be here till about 7 o'clock tonight.
Just, my colleague,
That's a good question.
Assemblywoman Lampert mentioned that company in Japan that went into default. So what's the mechanism for recovery? I mean, we had MF Global here in New York. Our former governor was running it. They had a problem, but people recovered their funds. There were intermediaries that stepped in that made it possible for those folks to get their money back. What's the recovery mechanism for someone who runs into a bad actor or whatever and has that type of situation?
Sure, good question. So in the case of Mt. Gox, what persons were doing were depositing Bitcoin with Mt. Gox, and they didn't have control over the Bitcoin. They were essentially giving control of their Bitcoin to Mt. Gox and depositing it there. And they defaulted. Either, we don't know exactly what happened, but either they ran away with the Bitcoin or the exchange was hacked and a hacker stole the Bitcoin. In this case, this consumer who is depositing money in Mt. Gox has no recourse except your typical recourse of a bankruptcy proceeding, you apply, et cetera. So we've learned from that. Okay, as a consumer, as an investor, you don't want to simply deposit your Bitcoins somewhere where you don't trust or don't know who is the person who is holding on to the Bitcoin for you. So what do? You can either hold your own Bitcoin, or you can use something called multi-signature technology. And so this is getting a little bit into the weeds, but I'll try to explain it simply. Not too far in the weeds. But quite simply, multi-signature means that you need 2 out of 3 signatures to move Bitcoin. So if you have an exchange, they could have 1 key, and you keep 2. So even if a hacker were to take the Bitcoin, or even if a hacker were to break in, they wouldn't be able to move the Bitcoin because you would retain 2 keys. My point is simply this. There are technological solutions to solving the problem that you're addressing, and they're being developed. Again, because something like Mt. Gox happened once in the past, doesn't mean that we come to the conclusion that this can never work. Right? If we had thought that way, we would have given up our search for flight, for example, our search for electricity.
Just one last. Do you own any Bitcoin?
Oh, yes, I do.
Oh, yeah, okay.
Of course.
Thank you very much for your testimony and your time. We really appreciate it. Next, we'll have
My
Charles Cascarilla. Is he here? No? Oh, there he is.
Is Webster
Good morning.
going to be entering all of this into
Morning.
some sort of
Who?
Webster's International Dictionary?
Good morning.
Still morning.
Thank you.
Good morning.
Thanks for coming.
having me.
Did you have, I don't know if you were here before when I made the disclaimer, did you have written testimony?
I do have written testimony,
Okay.
yes.
Then what I'd really appreciate is if you would just sort of summarize that, and then as you can see, we're going to ask you a lot of questions.
Sure. Maybe I'll just read 1 or 2 opening paragraphs to give you a sense of my perspective. I appreciate the opportunity to testify today. My name is Charles Cascarella. By way of introduction, I'm the Chief Executive Officer and co-founder of ItBit, PTE, which is a digital currency exchange based in Singapore. ItBit currently services clients globally outside the United States. We hope soon to open operations formally in the U.S. market as soon as we can in a manner that is regulatorily compliant, is without conflicts of interest, and which ensures transparency for both our customers and the regulatory community. Separately, I'm also a founding partner of Cedar Hill Capital and its venture subsidiary, Liberty City Ventures, which is an early-stage fund headquartered in New York City. Liberty City Ventures has a dedicated digital currency fund that invests in startups in the Bitcoin industry, providing them resources and a forum for growth. Liberty City's portfolio includes some of the most innovative startups in the space, like ItBit, BitGo, Plutus, SolidX Partners, and LibreTax. From these two roles, I'm pleased to offer two perspectives on digital currencies, both as an investor and an entrepreneur. My perspective is through the lens of having worked in financial services for the past 15 years, from Goldman Sachs to running an alternative investment manager. With this background, I have an appreciation and a respect for the importance of regulation in financial services and always have operated within those boundaries. So I'd maybe just stop there, and it seems like there's a lot of questions, and happy to just field them as they come.
Well, thank you very much. And I think that we all became a lot more knowledgeable. Jerry was very thorough. Why did you choose Singapore as the location to be the destination to be able to commence the startup of ItBit? What made it desirable there?
Sure. So we started ItBit 2.5 years ago, and I first got involved with Bitcoin over 4.5 years ago, believe it or not. And it was at the time when it was only at a nickel. And we're an alternative asset manager. We specialize in investing in financial services companies. And that's all I've ever done for my whole career, about 15 years, starting at Goldman Sachs. And when I first was exposed to Bitcoin, what seemed interesting to me was that it was sort of like Visa or MasterCard or MoneyGram or Remittance, but it was very early days. And so we didn't know what would happen, but we thought it looked interesting, and we started to get involved. And in order to buy Bitcoin at the time, we had to send money to Mt. Gox, which was at the time in Costa Rica. And that was fairly unreliable. And then we tried to withdraw funds from Mt. Gox after they sold it to the owners, eventual owners in Japan. And that was very difficult to do. In fact, it took almost 6 months for us to withdraw some of our funds. And we said, you know what, this is really difficult, and this is not an institutional grade exchange. And if Bitcoin is going to be a success, it is going to have institutions and companies that are operating in a way that people are very familiar around the world when they use other exchanges or other financial institutions. So that was the genesis for us to actually start ItBit. And the first thing we did was we hired, it was actually an undersecretary of the Treasury to help us create our compliance program and make sure that we could operate 100% compliantly. And it became very clear that to do that, you could not operate in the United States because you would need to have money transmission licenses or some form of banking authority. And so we opted to basically not operate in the U.S. and to just take non-U.S. customers while we continued to work towards the licensing, through the licensing process. And so that's why we ended up in Singapore. The Monetary Authority of Singapore is very forward-thinking. We sat down with the head of the Monetary Authority, or one of the senior heads, and meet with them quarterly. They're very familiar with what we do and how our compliance program is set up. We constructed it in a way so that it would be just like dealing with a bank in order to do know your customer, KYC, and just as importantly, anti-money laundering. We run all of our customers through a variety of checks, including databases around the world. So that's why we set it up in Singapore. We will have a U.S. arm, but it's predicated in our mind upon seeking permission, not seeking forgiveness. And there has been a variety of strategies in the Bitcoin world in terms of how to operate. Our view is you need to ask for permission. When we have the requisite permissions, then we'll launch in the United States.
Thank you. So ItBit is an exchange.
That's right.
Okay. So one of the questions we didn't ask Jerry is that it appears that there would have to be software written for this virtual exchange. No?
True. I mean, all exchanges are software in essence.
So because you would need to get some sort of coding to be able to code yourself as a customer, to own Bitcoins, to be able to go into the exchange. So there had to have been some sort of software system to be able to. So who created the software? Who owns the software?
And so we built it ourselves internally.
So you own your own software?
Correct.
For ItBit, okay.
That's right.
And other exchange companies have their own software?
That's correct.
All right.
else? Any questions? Senator Mukherjee?
Thank you, Chairman, through you. With regard to the treatment by FinCEN of some exchanges as money transmitters and so forth, have you taken a look, have your folks taken a look at the rubric of state laws and how that will juxtapose with the treatment of exchanges and transmitters and so forth, and what sort of problems would a proposal like New York's regulatory scheme there pose for an exchange like IPIT? And what sort of benefits might it offer?
So the conventional approach Bitcoin companies have taken is to apply on a state-by-state basis for money transmission authority. And some states like New York are crafting a new form of money transmission license called the BIT license. Other states are exploring something similar to that potentially, like California. And so we recognize, and I think very early on, that while Bitcoin is not currency and it's not money, it has currency-like attributes. And so it would therefore, if you were using it to change it for conventional fiat currency, in that instance, you'd be using Bitcoin as a money-like instrument, and therefore you'd be regulated under money transmission rules. That's not to say that I think it's a currency. I could be very happy to talk about what I think Bitcoin is. But if you can be using it like it's a currency, then it's under money transmission authority. Well, that's what we recognized. And we have spent quite a bit of time looking at what you would need to do in order to apply in a whole variety of states. And we're in process to working on a regulatory solution that we think will allow us to operate in the United States. And so you'd either have to be using money transmission authorities, or you could potentially be operating under a banking, some form of banking license that might give you reciprocity to operate in U.S. states, and you could also be perhaps a custodian, a fiduciary. So those are the two ways I think everyone has come to a consensus on what you would do in order to operate a Bitcoin business, an exchange. Certainly that's the route that we're taking, and that's why we haven't received all of our necessary approvals in order to launch in the United States. That's why we haven't done that yet.
Would it so although the beauty of Bitcoin is its decentralization, it'd be fair to say the risk presently is fairly centralized. Couple of the large exchanges.
Yeah, I think that's a good point, which is you have the way I try to think about what Bitcoin is, just to answer that question, is you have a closed ledger world, which is what we currently live in. And by closed ledger, I mean that you have a bank or a central bank that's keeping track of a ledger, and you don't really know what's in it. That's part of the reason why we had the financial crisis in 2007, 2008. Bitcoin is an open ledger. And that means everyone can see every transaction that's happened on it now or in the past. That's really powerful. But in order to get from the open ledger to a closed ledger, you need an exchange, or you need someone who will transfer either dollars or euros for Bitcoins. And so that's what Bitcoin is. That's what IPIT is. We're really, in essence, a translation mechanism from a closed ledger to an open ledger. And you have to do that in a compliant way because you have customers, you'll be having fiduciary authority, you'll have assets that are being custodied. And so that's how we've approached it. And I think you can very well understand then that if you have the right AML, KYC programs in place for exchanges, who are the on-ramps and off-ramps from the closed ledger world to this open ledger world, then you've created a very good level of security for customers.
Do you leverage?
No, there's no leverage.
Do you margin?
If you were to offer margin or leverage to U.S. customers, you would be, without regulation from the Federal Reserve, you'd be in violation of Reg T or Reg U, depending on if you were a bank or a broker. So we don't offer any customers. We don't have U.S. customers, but we wouldn't offer them unless we were in compliance with one of those statutes.
What do you think is left in order to start spreading some of the risk or allowing the smaller exchanges to come into the marketplace as the regulation of Bitcoin progresses, and what are the state's role in that progress?
Well, I think the states are really, they're the main gatekeepers here because of the way money transmission rules have evolved over time. So while you might register with FinCEN, you're licensed by states. And so that places responsibility upon state banking authorities, or depending on which state, there might not even be a licensing for money transmission in one or two of them. But in general, that means that the appropriate type of regulation and understanding of what Bitcoin is, and therefore, and what a company is using Bitcoin for. And so this is, I think, an important point. You could be, as we are, an exchange, and in that case, you're allowing customers are depositing funds with us, and then they're trading with other customers to either get Bitcoin or dollars, and then they're able to make withdrawals. We're both a fiduciary and a money transmitter in that instance. And we should probably be licensed as such, or even chartered. But if you're using Bitcoin not as a currency, but you could be using it purely because Bitcoin is an open ledger, and you want to move information through it. So you could be using Bitcoin not as a way to just move value. You could be using it as a way to move information. And so that's the analogy I draw is that Bitcoin is to information authentication what the Internet was to information distribution. And so what that means is, because you have this open ledger, you could take a fraction of a Bitcoin, practically worthless. And I think the New York Department of Financial Services actually made this point yesterday in their BitLicense comments. If you're moving almost a worthless amount of Bitcoin around, 0.00001, you can still attach piece of information to that. And when you send that fraction of a Bitcoin to someone else, you now know that you have this fraction of a Bitcoin and whatever was attached to it. So, for instance, you could attach your grades to it. You could attach a birth certificate to it. You could attach your voting records to it. Absolutely. It's like a mortgage title or a property title. So you can actually move ownership of digitized deed from one person to another on a very fractionless amount of Bitcoin. Alternatively, so you might be moving some information that's very valuable or some information that's not that valuable at all. And so that's the key point I would make, is that how you use this open ledger determines what is regulated. So it's the activity that's regulated, not actual Bitcoin itself. And so, and when you think about this concept of an open ledger, it shows you how foundationally it can change the financial system. Because now you know everything that's moving. You can follow chain of title for all forms of different assets. Say a mortgage or a deed to a piece of land. You have to go to a registrar's office now, and you have to make sure that someone else doesn't have a lien on it. You could, in a future state, far from now, you could actually go to the Bitcoin network, and you could track what happened. So this is really very powerful, and so there are types of innovation that are happening that probably don't make sense to be regulated, whereas something like what we are as an exchange, ItBit, should be, because we're holding customer funds. We're acting in a fiduciary authority.
I have a quick question. You've obviously paid a lot of attention to regulatory schemes throughout the United States. What state do you think has been the most effective? What kind of regulations would you craft if we gave you a blank piece of paper?
That's a good question.
Thank you.
I think it depends on your perspective to say which state you think has been the most effective. We are based in New York and live in New York, so I'm going to be a little biased and say that I think New York has done a very good job at being at the forefront. There's differing views within the Bitcoin community or the wider community upon what is the right amount of regulation to put in place. But I think that the New York Department of Financial Services has really committed themselves as an institution to spend a lot of time and a lot of resources to try and get this right and have a long comment period. And not everyone is necessarily in agreement upon where they've gone with the BitLicense, but I don't think anyone can doubt that they've been very thoughtful about it, and that they spend a lot of time on it, and far more really than almost any other institution. When you have a conversation with the department, you can tell that they've really climbed into it more than some community members. So I think if you maybe pinpoint someone, I would say New York. And I was just alluding when I was answering the earlier question that again it comes down to how are you using Bitcoin. So if you're moving a practically worthless amount of Bitcoin, probably shouldn't have any real regulation. If you're a custodian of customer funds, perhaps you should have some kind of either money transmission license. But if you're really being a custodian, perhaps you should have some kind of custodianship, and perhaps a trust charter or some other form, or which could very well have reciprocities. Or if you're moving, say, something of value in a future state, say you took a practically worthless amount of Bitcoin, but you started to move mortgage titles through it. There's probably some regulation that should happen there. That's more difficult, and that's in the future. But I think that's the way I would approach how you would really try to be even-handed about promoting the innovation around the software, whereas protecting customers who could have funds that are exposed to an exchange process. And so then there's this concept of having a wallet, which is not really a bank, but it's kind of like a bank for your funds. It would kind of be like, it's almost like having a credit card or a debit card, but it's just digital. And so a wallet is a debit card that allows you to spend your Bitcoin. So a software company that provides a wallet might not be regulated, but a software company that provides a wallet and allows you to buy Bitcoin, maybe they should be. So that's where you start to get into the nuances, and it gets a little, becomes a gray area, and it's just an education process about making the call for what is appropriate for any given state.
Okay. Just one last question. How does ItBit make money?
We charge a fee for anyone who trades with somebody else. So we act purely as an agent and as a custodian. And the only fee that we're charging is when one customer trades with another customer. They're never trading with us. We're never selling anything. We're never trading against our customers.
I have to admit I'm more confused about this, and I realize that I'm getting old when I hear all this testimony. What you testified to about being able to attach deeds and mortgage, that raised a concern for me. How would they go about doing that? How would you attach a mortgage or a deed to a Bitcoin?
Yeah, well, I think that it's partly confusing because I think it's confusing for everyone because it's a complex process how you move a mortgage title through an ownership process. So the way a mortgage is originated today is very cumbersome. You're going through many different types of ownership steps. So if Fannie Mae was to eventually have your mortgage, someone else originates it. That whole process of moving it through all those entities is very complex. So it's conceptual to say that you could use this open ledger to eventually move ownership of an asset like a mortgage. It might be easier to take something that's less complex and that would involve, I think, some more innovation. Like, say you wanted to move ownership of a gold bar. It's a little bit easier to do. So if I'm the vault that holds gold bars, and someone bought a gold bar for me, and I would then issue them a token of a Bitcoin, essentially a practically worthless amount, that has attached to it the digital ownership that represents the gold bar they bought. And then if you take that gold bar and sell it to someone else for Bitcoin or dollars or whatever, that Bitcoin is then transferred to you. You just bought it. And then you come to me with your Bitcoin that only you can show that you have because you have the private key that shows that you have the ownership of that gold bar. And then I know that you have the ownership of it, and if you wanted the gold bar, you could have it. So you can transfer the ownership, and so you'd have to make it much more complex, and then you could do a mortgage title.
Let me ask you a question. That all would go onto that open ledger, all those transactions?
That's right.
Okay. So I can see where you would move a gold bar from one to the other because it's going to be in that ledger. But when you're talking about a mortgage, you got to file it with the county where the property is located. So how do you
That's
go
right.
from a Bitcoin to the registrar's office?
That's the real question. It's the same thing with a card title. You would have to eventually create an interface into the county registrar's office, whether it was with a mortgage title, a card title, it's the DMV. Each one of these more complex ownerships, you wouldn't be in a position to move it now, right? It'll have to be. It's something that can underscores the power of what an open ledger is, not necessarily what it could do today. Analogy I use is I kind of think Bitcoin is similar to a couple technologies we're familiar with, but the one that I like a lot is thinking about it like cellular phones. So if you remember a cellular phone 25 years ago, it was an analog phone, and it wasn't even a cell phone, it was called a car phone, right? And we can remember this, and it was pretty bad. It was like $4 a minute, and it dropped your calls. So if you were stopped somewhere, you would go use a payphone or a landline way before you would want to use your cell phone. But you fast forward 20 years from now, no one even really has landlines necessarily anymore. And that's to show you that cellular technology is foundationally better than a landline. But it doesn't mean that it's better right now to use. And so that's the same way I would describe open ledger technology is fundamentally better than a closed ledger, but we haven't developed the technological solutions to use this new tool in the same way we hadn't developed the same type of cellular network that allows us all to be getting YouTube like we do now. Right.
My last question is this, is that this, so this is on par to solar energy to me. So you use the cell phone as an analogy. I've got solar, where solar and SREGs and solar many years ago had a great value to its attached to its SREG. Now it's completely plummeted, right? Mm-hmm. So fees. So when Bitcoin started and fees were attached to the exchange, right? Where did the fees start, and where are we now in terms of what is an average fee that's attributed towards the transaction of a Bitcoin?
Sure. So if you wanted to go exchange dollars for Bitcoin, for instance, if you came to our exchange, we have it set up so that on average, there's different amounts depending on how much you trade. You would pay 20 basis points, so 0.2%. And that is a little bit lower than some of the other exchanges, but that's down from where we were, say, 3 or 4 years ago, where you're at 1% or even a little bit higher, depending on which exchange. And to give you some context for that, we actually pay more in Singapore when we want to transfer Singapore dollars to U.S. dollars. Our bank charges us 35 basis points. So we actually pay more to transfer between two fiat currencies than we charge our customers to go from a fiat currency to Bitcoin, which gives you some sense that we've already come quite a long way in terms of making it the transactions very competitive, and I think that they'll only get more competitive over time in terms of what the pricing does. And so practically, you can think about it only costs you 20 basis points to go from an open ledger to a closed ledger. That's not bad. And I suspect it continues to go lower.
Quick question. You were mentioning things being attached to a very small amount of Bitcoin and traveling through the ethersphere, I guess. A will that has various signatures, as the other gentleman who testified, travels across that way. And the signatures, from my understanding, are an algorithm. Is that right?
That's right.
Okay. What is the potential of compromise of the signatures? Because it doesn't have to be exactly the algorithm. It has to be relatively close for it to open up. Isn't that correct, or am I incorrect?
No, the algorithm has to be exactly right. So, in other words, if I understood your question correctly, in order for you to be able to access the will, you have to have the private key in essence, just like a key you keep in your pocket. And if you don't have it exactly right, you cannot access it. And you don't, in fact, you can have it set up that you can't, not only can you not access the will, you can't even see that there's a will there unless you have the private key.
Thank you.
Yes.
Thank you very much for your time. and
pleasure.
for Did you come from Singapore? If so, you get the distance award.
No, that would be something else. Just not too far, New York, 1 hour.
Thank you very much for your
Thank
time.
you.
Thank you. Okay. Next is Robert Wilkins. He's the CEO from Zifter Coin. Mr. Wilkins?
She makes this trip over here like it's nothing. I know. Like 18 hours. She does the direct design.
Good morning.
Good morning.
Good morning.
Almost, still.
Almost there. I do apologize in advance for my sore throat, a little cold and a little yellowing at the Super Bowl.
So who were you rooting for?
I grew up in Seattle, so I'm still not over the call. So I do have a brief summary statement to read, and then I can take any questions you have. Great. Again, thank you for having me here today to discuss cryptocurrency. My name is Robert Wilkins. I'm CEO of Zifter, an online shopping portal that you can compare offers of tens of millions of products from over 10,000 plus retailers today. Zifter has been around since 2008 and has raised over $7 million in capital to date. We are also the creators of Zifter Coin and Zifter Pay. Before Zifter, as EVP and president of PC Connection, for 11 years, where we took a company from $250 million in revenue and losing money to a Fortune 1000 company and $1.6 billion in sales in public. I personally started up over 6 startup companies and have had 2 IPOs. I've raised over $150 million in capital to date. I've created over 10,000 plus jobs and employed over 25,000 people in my career. So I'm an executive entrepreneur. I've been around and I like still doing startups. I'm also a Bitcoin miner, and I got into Bitcoin back about 1.5 years ago. What is Bitcoin? Bitcoin, in the simplest sense, is an accounting ledger of every transaction that's ever happened between 2 parties on the Bitcoin network. This accounting ledger, however, is not governed or owned by a central authority like a bank. The accounting ledger does not sit on a centralized server. A copy of the accounting ledger, which is called a blockchain, sits on each PC, mobile device, or server that is used in the Bitcoin network. This is called a distributed system run by a peer-to-peer network. Because each person in the network has a copy of the accounting ledger, Bitcoin becomes a most infeasible way to attack, take down, or take offline. If an attack were to happen, the whole network would know and see the attack is happening. This type of system is much more reliable than centralized systems such as those that exist today. What are Bitcoins? They are digital tokens given as rewards to people who are willing to use some of their computing power to help verify and do transactions on the network. This is referred to as mining today. Bitcoin has never been broken. There, however, have been many companies in the Bitcoin ecosystem that have been broken into, and coins were either lost or stolen. This has nothing to do with Bitcoin security. It has everything to do with the companies who were broke into and their security policies. Just like when Target, Home Depot, and many larger companies exposed people's credit card information to hackers, this had nothing to do with the credit card companies. The breach had to do with companies' security around user information. Now, if some of those companies have been taking Bitcoins for their services and a hacker was able to get into their system like before, for those customers who used Bitcoins, the security breach would have not mattered. Why? Because cryptocurrency is a spend-only protocol. There's no number left behind, like a credit card that can be charged over and over again. This makes cryptocurrency much more secure for the consumer and merchant than taking credit cards today. Security, along with lower transaction fees for merchants, is why companies like Overstock.com, Expedia, Dish Networks, Newegg, Tiger Direct, Microsoft, Dell, and hundreds more now take Bitcoins in the form of payment. So what is ZifterPay? ZifterPay is a service that allows merchants to not only take Bitcoins but other altcoins as well as a form of payment. The ZifterPay platform uses Bitcoin exchanges to sell the Bitcoins for cash, and the cash is directly sent to the merchant. To the merchant, taking cryptocurrency looks like taking a credit card without the fees and chargebacks associated with credit cards. So what is ZifterCoin? ZifterCoin is a new altcoin. It is considered a gateway coin designed to bring the next 10 million users into cryptocurrency. We're doing this by giving away 300 million coins. By giving the coins away, the consumer does not have to go through the current process today of acquiring Bitcoins by either learning how to mine them or by purchasing them on exchange. ZifterCoin is like a coupon where you can use up to 5% of your coins for a minimum redemption value of $1 when used in our merchant network. So why is it important to let this technology flourish and even help people adopt it? Well, I remember when I first saw Mosaic in 1993, the real first web browser. It was the first browser that allowed images on the page. I knew the world was about to change. It allowed for an easy creation of publication of information and transactions. The browser created a new world, a new way to communicate, a new way to create commerce, a better way to do almost anything, and we're still seeing things 20 years later being built and brought forth from this technology. However, what we know and take as commonplace today, texting, placing orders, finding places, hailing a taxi, online learning, the list goes on, is not how the web was perceived when it was first started. The web, when it first came out, was a dark and mysterious place, mostly unknown companies pitching their services and goods. Companies like Amazon. Wouldn't you have loved to have an Amazon started right here in New Jersey? The first time I saw Amazon, they wanted me to send a check to place an order. That seemed scary. Then they allowed credit cards to be taken online. In the first 2 years of the web, 90% of the people who went to a web page to place an order called the order in instead. They didn't trust their personal information to this web thing. Think about that versus today. The web we grew and succeeds in creating hundreds of billions in revenue and countless new jobs because there were very few regulations put down in the beginning. The free enterprise market shaped what the web would become based on entrepreneurs' free thinking to create goods and services and letting consumers demand and pick the winners. Where would we be today without the web? Think of all the things you depend on today. Think of all the opportunities it created. Think of all the costs it saved. Think about all the companies and old business models it disrupted. People and companies were nervous 20 years ago. That's all right. Change is always a little difficult. Just don't fear it, embrace it. We need to allow cryptocurrency technology behind Bitcoin and other altcoins to move forward based on free enterprise and unbridled thinking. We need to let consumers pick the winners, and we need government bodies to do what they did 20 years ago, help enable us in doing new things. Thank you.
Oh, I'm sorry. Go ahead. No, Assemblywoman Caridi.
The name of your coin is what? Zifter?
ZifterCoin.
So it's a competition to Bitcoin?
Now, we see it as an enhancement to Bitcoin as far as getting people to use Bitcoin. The average consumer today, if they're interested in Bitcoin, has to go through one of two processes to acquire. They either have to open up an account, which can take 3, 4, 5 days to do, link their checking account to it, buy the coins, and then put them into a wallet. For most people, they're not going to do that. The other process is the act of mining, and 99% of the people won't do it. What we're doing with ZifterCoin is we're giving them away in a merchant network that has some type of redemption value to get used to doing it. It's like having your first credit card. I want to go through the process. I want to see how it works. I want to put it in a wallet. I want to actually make the transaction work. And our belief is that if you get used to it through ZifterCoin, you'll then get into Bitcoin and some of the other coins that are out in the marketplace.
Next question. So if you're giving them away, how is your company making money?
So in the back end of the marketplace, there's things called affiliate fees that are associated with transactions that happen on the web today. There's fees associated with marketplace listings, and there's margin in all of those. And so we're using that margin to cover the cost for the extra 5% discount that happens at the time of the transaction. It's really like a coupon. Here's $100 worth of coupon tokens that you can use, and you can go to one of our merchants and, like a credit card, click pay and put them in, and the transaction's done, and you get a discount on your order.
Thank you. Assemblyman Off.
Thank you, Chairman. Through you. Sir, you said you're a minor, right? And,
Yes.
do you belong to a pool?
Yes, many pools.
Many pools. Could you explain how that works and the benefit to you and the public, I guess, at the same time?
Yeah. Different coins have different algorithms they used to be mined. And the difficulty in the algorithm goes up depending on how many miners are going to mine the coin. So if you try to mine by yourself, depending on the type of computing power you have, your odds in time of hitting the blockchain to get the reward at the end is very minimal. So if you pool with a lot of other computing power pointed at the same coin, your odds increase because of the amount of computational power is happening, but what you get is a division. So if the blockchain happens, you get the coins, the pool divides up the rewards.
Thank you very much.
You're welcome.
Sounds a little like a video game to me. But just a couple questions. Are there any states that accept cryptocurrency?
Not today, but the state of New Hampshire, which is where I'm from, actually has a bill in front of it today that the state will look at accepting cryptocurrency by the year 2017 for taxes.
And how does the IRS treat it, assess it?
Right now, the ruling with the IRS, it's a piece of property.
Okay. Anybody else have any questions? Well, thank you very much for your testimony. Hope
Thank you.
Hope your throat feels better, and
Thanks.
you can go when they induct Pete Carroll into the Patriots Hall of Fame. Leonard Nuara? Nuara?
There's two of us. There's myself and my colleague, Christian Martin.
Okay. Oh, I'm sorry. Yeah, I agree. I mean, I see it here. I apologize. Mr. Martin, come on up.
It flipped to afternoon, so good afternoon. I'm Lenny Nuara, along with Christian Martin. We are the co-founders and New Jersey residents, lifelong New Jersey residents of Terra Exchange. Terra Exchange is a derivatives exchange regulated by the Commodity Futures Trading Commission, so we are fully regulated by a federal regulator. We're here to talk about a variety of aspects of our business, but let's just talk a little bit about ourselves. I'm a 30-year practicing attorney in New Jersey, representing people from Wall Street in a variety of venues, and I'll let Christian talk about himself.
Sure. Thank you very much. I'm 25 years Merrill Lynch and B of A as a derivatives expert and trader, managed risk around the globe. We founded Terra Exchange 3.5 years ago. I was born in Union, New Jersey. We are the first, as far as we know, the first and only federally regulated exchange in the history of New Jersey. And we're happy to take your question.
Otherwise known as the Jersey Boys. That's us. So I provided to Mark a PowerPoint presentation that we had been using for other meetings, but it has a lot of background in the industry, so you're welcome to, Mark will probably pass it out if he has some time.
How are you different than the other exchanges, or are you?
At the most important level, we are a derivatives exchange, so we are more akin to the CME, the commodity futures trading. The commodity futures are different than the underlying. So we do not trade Bitcoins themselves. We are a derivative of the Bitcoin that's based upon an index, a proprietary index that we produced. So we're more like the futures exchanges that you know of in Chicago or others like that.
The derivatives would also be these things that are attached to a Bitcoin as well. Isn't that a derivative?
Yeah, a derivative derives its value from the underlying. So our derivatives derive their value from the price of Bitcoin, and actually specifically the price of the Bitcoin index, which we created. we have connected to 14 different exchanges around the globe, and we have to go through a certain filtering process to come up with a fair value price of Bitcoin. That was actually part of our regulatory lift with the CFTC to come up with an index that is not susceptible to manipulation. So we had to get to a price point of Bitcoin that was not susceptible to manipulation, and the way we do that is through connecting to all the exchanges and then aggregating the data.
You have a question?
No.
Oh. Okay. Anybody else have any questions? Okay.
Your company is regulated, correct?
We are.
But then Bitcoin and the exchanges, they're not regulated.
Correct.
So how does that work with your company? I mean, it's like half of it is regulated, the other half isn't?
No, what Christian just mentioned a moment ago, we produced an index that represents what the value of the Bitcoin is. So it states people are using exchanges such as the one you just heard from a few minutes ago, ItBit. They're a contributor to our index. We pipe their data in, and we just say simply we average all their prices across all those exchanges, and we establish what the value of Bitcoin is at any one moment. And then participants on our platform decide to trade on a futures basis for tomorrow, the next day, or someday in the future. What do you think the Bitcoin will be worth at that date? The reason that that's needed is from the traditional industries like grain, cotton, corn, gold, or any other places, there have long been futures exchanges to allow people to hedge the risk of changes in prices. Because a farmer, for example, is growing his corn, he's worried, hey, how much am I going to get for this corn? I know it's going to cost me X to get it out of the ground and deliver it to the market, but I want to lock in a price. So the futures market has long existed in the United States and around the world. We're doing the same thing for the Bitcoin price. So we don't have to touch the Bitcoin, but we take feeds from all of the exchanges, ItBit being one, but Bitfinex and many others, and produce a synthetic that represents the average price across all of them. And then participants that want to hedge their risk of where Bitcoin price will be tomorrow or next month or next year, and then they can do a trade on our platform to do that.
It's almost like when you're buying stocks.
It's like buying stocks. It's a little bit more sophisticated than that. Futures are another type of exchange security, and these are futures. They're like futures. Ours are specifically called swaps or non-deliverable forwards, but it's in that same ilk.
So like your clients that want to hedge their bets for tomorrow, they would then lock in at tomorrow, what you think might be tomorrow's rate, and that's the bits that they would have, Bitcoins that they would have then in their account? They would buy that?
Yeah, they're actually, ours are what are called cash settled, so they don't have to touch the Bitcoin, but you and I may do a transaction on our platform where you're worried that the price is going to go down, right? And you see the Bitcoin price, and if you've looked at any of the charts, it goes up, it goes down, it goes up, and it goes more wildly maybe than some other assets, more wildly than maybe a gold or some other currency. People trade currencies all the time. But what they want to do is lock something in sometimes. Some people want to speculate, but let's just take the person who wants to lock it in. You're a merchant, and you're taking in Bitcoin. You're like, wow, are these going to drop in value? So you could potentially lock it in. So you'd come to Terra Exchange, and you would do a transaction with another party that says, hey, I think, will you agree that it's worth X tomorrow or the next day? And you find the other counterparty on the platform, and you do that trade, and now you've locked it in. Now, if the price goes up, well, you didn't get the benefit of it going up, but you've locked in your downside. And that's just one example.
What happens when all of the Bitcoin are released, all 21 million, and now they exist? How's that going to affect the index?
Well, in the first instance, it'll be the year 2140.
Okay.
When that happens.
Okay, so I may not have to worry about it.
Just wanted to bring you up to speed on that. But there's a inventory of Bitcoin.
Don't worry about that.
No, it's no different than gold or anything else.
Okay.
There's a finite inventory.
Yeah.
And so whether there's more or less, people always know how much there will be, and so therefore people will push the price up or down based upon the scarcity.
But people could use yours to speculate. Can they, buy?
Yeah, they
sell
can.
short, buy long.
They can, right? I mean, it all starts with traditional balance sheet management and the tools that have been at the disposal for treasurers and CFOs for currency fluctuations or interest rate fluctuations that Wall Street's provided solutions for through derivatives for really 40 years. it's becoming necessary in the Bitcoin ecosystem. The Bitcoin community, which, you know, we're a vertical capital markets extension of. We're really not involved in the Bitcoin mining or the cryptology of, and all the great things you've heard about from the other testifiers. But what's becoming necessary is capital market solutions to manage risk and manage balance sheet. You can certainly do it on the other side. You can certainly take risk using a derivative product, and frankly, you need kind of both. You need the liquidity provider, and you need the hedger. And the hedger is happy to hedge their balance sheet and hedge their Bitcoin risk, and the speculator is happy to internalize that risk and trade it the way they would trade any other risk.
Yours is pretty sophisticated stuff. This is not for the average investor, right?
It is and it isn't. Futures markets in the States here are a $40 trillion marketplace. The swaps market, the over-the-counter market, is a $700 trillion marketplace. The Bitcoin derivatives marketplace is the grand total of a few weeks old. That's us. There are actually others around the globe that are much more retail-focused, but we are focused specifically, and we're regulated specifically.
Who regulates you?
The CFTC.
Okay.
We got that certification in the fall in September, and our Bitcoin products were regulated at the same time. So we recognize the opportunity, and we went into it purely from a capital market standpoint as a solutions provider to those who need it.
So what do you see as the risks of Bitcoin? Things that that you're afraid of, that will drive the market off the brink?
Well, we're the echo effect of the underlying. So if you think of any other commodity, if there's a terrible drought or there's a terrible event that affects or decimates pricing adversely or one way or the other, if it becomes so that Bitcoin becomes something that people don't care about anymore, well, then we've just created a derivative that no one cares about because you need to care about the underlying. So from a commercial standpoint, the network effect, the adoption of Bitcoin from in our, this is certainly, these guys know behind me better than I could tell you, but I think 0 merchants took Bitcoin in the States a couple years ago. We're up to the better part of 100,000 merchants accepting Bitcoin, and you heard some of the bigger names, the Microsofts and the Overstocks. That's a good sign for us that these solutions that we provide are necessary and really hopefully becoming more and more necessary, so we can have a thriving business.
Do you think it's necessary that there's regulation that doesn't exist that ought to exist relative to Bitcoin?
Yeah, there's two answers to that. In the first instance, we're at the federal level, right? So there is federal regulation for exchanges that are truly federally regulated exchanges, and there's a need at some point for the federal regulators to recognize the underlying exchanges, the ItBits of the world and others, whether they will be regulated by the CFTC or the SEC or otherwise. Right now we're regulated because we're doing a derivative, and derivatives require regulation, and so we're regulated by the CFTC. The SEC hasn't made its determination as to whether they're going to regulate the ItBits and the other underlying exchanges. But at some point, regulation there would be helpful because of what many of you have been talking about today, which is what happened at Mt. Gox or other places. There needs to be some safety and soundness. Now, we have all that in our infrastructure. We are already federally regulated, and we heard some wonderful testimony from ItBit before about how they built their infrastructure, and they're ready to be regulated. They do all the things for securing customers' money and handle everything on a fiduciary basis and so on. So regulation of exchanges such as that are, I think, very helpful, and welcoming the underlying cash markets, the Bitcoin exchanges, into regulation, I think, is helpful. But also your money transmitter laws that you already have, if you just add cryptocurrency to the money transmitter rules and so on that you have, then you can at least have control of that, watch it, monitor it, and also handle the bank secrecy issues and other AML, any money laundering, and know your customer stuff that's already in those laws.
Okay. Well, thank you very much. Thanks for your time, for your testimony, and thanks for staying home in New Jersey. All right.
Cheers.
Marco Santori, counsel from Pillsbury, Winthrop, Shaw, Pittman, and Santori maybe someday. Hi.
Good afternoon. My name is Marco Santori. I'm an attorney with Pillsbury Winthrop, Shaw Pittman. We're a global law firm, hundreds of attorneys around the world. We represent quite a few different companies, but today I want to talk to you about just a short segment of those companies, which is digital currency companies. Pillsbury Winthrop is one of the leading firms in this space, and to give you a sense of scale, we have counted among our clients probably almost 100 different digital currency companies at this point. So this isn't just a couple of guys in their garage anymore. This is a very big deal in a lot of ways. In addition to Pillsbury Winthrop, I am Global Policy Counsel to a company called Blockchain.info. We're the world's largest consumer wallet service software provider. And I also chair the Bitcoin Foundation's Regulatory Affairs Committee. So I had a script, but I understand we're short on time. So I think at this point, you've gotten a lot of information about what Bitcoin is and what it does and what it might do one day. What I'd like to help do today is try to distill that into a path forward. Now we have all this information, what are some of the things we might do with that information from a legislative standpoint, from a regulatory standpoint? So you may have heard about, you might have heard one thing about how digital currency companies are regulated. It's critical to understand that right now digital currency companies are among the most heavily regulated companies in America. Digital currency companies on the federal level are regulated by the Bank Secrecy Act and the Patriot Act and various other implementing regulations that FinCEN, a Bureau of the Department of the Treasury, the Financial Crimes Enforcement Network, administers. The treatment on the federal level for for digital currency companies that are engaging in money services, like money transmission, like the exchange, one of the exchanges you heard from today, are subject to FinCEN oversight. Now, there's still an ongoing question as to what other oversight they're subject to on the federal level. We may see CFTC regulating people, as we saw with TerrExchange, who are using Bitcoin or digital currency derivatives. We may see SEC regulate companies in the space who are using Bitcoins as securities. Remember, as we were talking about, attaching a security to a Bitcoin, or possibly even Bitcoin companies raising money by issuing digital tokens. This may one day come under SEC oversight. It isn't today, but it might. But that's actually relatively certain as opposed to what's happening on the state level. And that's probably what I think might be most worthwhile use of the time here today, is talking about how digital currencies are regulated on the state level. I want to say right now that I believe that the task before any state regulator or legislator is, as it is with any new technology with risks and benefits, is maximizing the risks and minimizing and mitigating, maximizing the benefits and minimizing and mitigating the risks. And digital currency entrepreneurs, by the same token, are on the hunt for a jurisdiction that will do this because of what they've experienced under FinCEN oversight, because of what they're experiencing on the state level right now. So states have taken three different approaches to regulating digital currencies. The first approach, so far by the numbers, the most popular approach, is by publishing a formal interpretation, given the regulators will publish guidance on how their existing laws apply to digital currencies. Some states that have taken that tact are Texas and Kansas. This approach has generally been lauded by the digital currency community, although there have been some detractors. And it has the benefit of having a very low legislative footprint. It doesn't require passing any new laws or anything like that. At the same time, it suffers from a round peg, square hole problem. Existing money services laws just were not meant to regulate digital currencies. That much should be true. New Jersey's Money Transmitter Act, for example, was enacted in 1998, and it was intended to apply to money that was held in and sent by banks. Bitcoin, that's just not how it works. That's just not how it works. It's usually individuals that are holding and sending money on their own behalf, or sometimes there are custodial entities that will take custody of Bitcoins and send them on other people's behalf. But none of these implementations were considered when the drafters first put together these rules. I think Bitcoin didn't exist in 1998. It was just invented a few years ago. So here in New Jersey, to be specific, the money transmission law doesn't actually define money transmission. It says a check. It defines some instruments, as check, money orders, payment instruments. It doesn't even define money as something that Bitcoin might fall under. In fact, money is specifically defined as a medium of exchange authorized and adopted by the U.S. or a foreign government. I think that for this reason, trying to fit digital currencies into an existing regime might not be the most effective approach. There's another approach. This is what we've seen in New York. And that's to create a new suite of regulations tailored to digital currencies. This is the BitLicense proposal. And this strategy has an enormous benefit because you avoid this round peg square hole problem. You say, look, this is what the digital currency is today. This is how we want to regulate it. And you gather a bunch of experienced, intelligent people in the room. They tell you what digital currency is. They tell you what their predictions for what digital currency will be in the future. And based on that, you write a law, or you propose a regulation, and you promulgate that regulation or pass that law. But this also has its risks. It's technology-specific regulation. And technology-specific regulation always has its risks, and these are temporal risks primarily. In order for a technology-specific regulation to work, it contemplates and expects that innovation be frozen in the moment in time that the law was written, or at least builds in some flexibility to build in all of the developments that a legislator or a regulator might predict will occur in the near future. You might already understand where I'm getting at. This is just a nightmare with digital currencies. If you would have asked me a year ago, what do Bitcoin businesses do? I would have told you one thing. I would have said they're exchanges. They convert dollars into Bitcoins and vice versa. If you ask me today, what do Bitcoin companies do? Well, gosh, it's not even just exchanging. It's not even just currencies. These companies act as payment processors. They act as media of exchange for things that aren't currency. Things like smart contracts, chain of title products, businesses that a year ago we would have never thought you could implement this stuff. There's just no way. And so you look at today, what we knew a year ago, it only really makes your mind boggle as to what you might think you can expect a year from now. This industry is too young for technology-specific regulation. We may find ourselves legislating now to pen in and require licensure from companies that exist as they do today, and find in a year that everything we thought was right was wrong. And that's always a concern whenever you pass regulation. But when you're dealing with an industry that's moving as quickly as this one, I think it's not the most effective way. So there's a third way. This is the final way. This is the final way that states have addressed this problem. And that's by taking a wait-and-see approach. And I got to say, in my mind, there's merit to that approach. If creating a new licensing regime from scratch might end up being short-sighted, if trying to fit in digital currency companies to existing regulation might not be effective, maybe it makes sense to wait and see how digital currencies evolve. Monitor the industry to determine which risks disappear, which risks persist, and then act only when you are reasonably certain that the industry is going to be this way for some time and that your actions are going to be effective. But, as you might guess, I don't think that's the ideal approach either. It has a few problems with it. One, while policymakers wait, consumers are left without protections against the risk of fraud, negligence, and just plain risky and reckless business practices. There are some good reasons to hold the custodians of our money to a higher standard than other businesses. The second problem, while policymakers wait, so do innovators, so do investors, so do prospective customers. Regulatory uncertainty is the most effective method of slowing growth of a new and groundbreaking industry today. The third and related problem is that while policymakers and regulators wait, the state is missing out on all the benefits that come along with being a home to digital currency companies. Last year, over $400 million was invested in digital currency companies. The year before that, less than $100 million. This month, over $100 million. If you do the math, you're seeing exponential, explosive growth in this industry. That is a lot of money. That is a lot of money that could be, that is right now, that could be spent creating New Jersey jobs, leasing New Jersey office space, renting New Jersey apartments, buying meals from New Jersey restaurants, and paying New Jersey taxes. But instead, Right now, all that money is being spent in California and in New York. Unless New Jersey develops this new digital economy in its own state, it'll watch as that money gets spent in other states and even other countries. So for this reason, I'll close by suggesting an alternative approach. And that's one that contributes to an atmosphere of regulatory certainty and balances the potential for economic progress against the need for consumer protections. It means considering new legislation that incentivizes digital currency businesses to home in the state of New Jersey, while ensuring that those businesses are appropriately monitored as they manage its citizens' money. It doesn't mean building a new licensing machine. It doesn't mean demanding compliance with a regime that was never intended to fit digital currencies. Instead, it means a well-thought-out combination of carrots and sticks that demand accountability while incentivizing new economic growth. For example, who might New Jersey regulate? Well, it makes sense. It makes sense to regulate custodians, not mere software companies. We should ensure that the people that we trust with our money are trustworthy, but permit mere software developers to innovate and build this ecosystem. What might we require of those people? Well, at this stage, I think registration is appropriate, not licensure. We should maintain accountability without excluding emerging businesses. We might want to require fingerprinting to make sure we know who's holding onto our money. I think we should absolutely consider robust anti-money laundering, requiring robust anti-money laundering policies, as is done in many other states. And we might require regular third-party solvency audits and cybersecurity audits. Ensure that these companies aren't operating a shady fractional reserve quasi-bank, and ensure that what happened in Mt. Gox, which was a combination of mismanagement and various other things, doesn't happen here in New Jersey. Now, those are some sticks. What about the carrots? Well, for one, creating a registration regime instead of a licensure regime means that New Jersey entrepreneurs don't have to ask permission to innovate. And that's a particularly attractive carrot in its own right. Alternatively, if New Jersey does adopt a full-blown licensing regime, it might consider granting reciprocity for businesses who already have a license in another state and home in New Jersey and employ New Jersey residents. We might consider tax breaks and some other financial incentives like tax credits or grants for digital currency businesses and ancillary service providers. We might even consider formally legalizing the use of digital currency in New Jersey's active casino and gaming economy. So in closing, New Jersey is faced today, in my belief, with a historic opportunity to become a hub of the new digital economy. Digital currency entrepreneurs are building this economy right now. And I ask that you give them a good reason to build it here in New Jersey. I have one that's embarrassingly marked up, but I'd be happy to...
If you could send it to Mark, I'd appreciate it, because
I would be glad to.
I think that you have some terrific ideas there. Any questions? Thank you very much for your time. We really appreciate it.
Thank you.
Good job. Thank you, Mr. Santori. Brian Stokert.
Good afternoon.
Good afternoon.
Good morning. So, my name is Brian Stockert. I'm managing director of a firm called CoinComply. What we do is we work exclusively with the financial technology and digital currency market on compliance. So, we've been in market approximately a little bit more than 2 years at this point in time. We have a presence in New York as well as a presence in Silicon Valley. Me specifically, my background's in a little bit more than 10 plus years in anti-money laundering compliance, sanctions, assisting executive management teams at financial institutions that are under consent orders, money service businesses, as well as international intelligence firms. Prior to starting the company, I managed an intelligence practice at Booz Allen Hamilton. I do have prepared testimony, but I'd rather just sort of roll with a couple of issues that are percolating and have been mentioned a little bit earlier today. With regard to anti-money laundering compliance, it's definitely a serious matter. It's a serious matter mainly because of illicit threat, illicit finance. Currently, all financial institutions, as well as so-called non-bank financial institutions, aka money service businesses or money transmitters, are required to maintain anti-money laundering compliance. So what does that mean? At the federal level, that means you need to maintain a written anti-money laundering program, all right, which also includes knowing your customer identification program, appropriate level of training, a designated compliance officer, an independent test, either done by someone internal who's not the compliance officer or by sending it external to a qualified third-party consultant, as well as sanction screening. While there's no requirement that a financial institution actually perform sanction screening, it is a requirement that that financial institution and or its individuals does not actually perform a transaction with anybody identified on specially designated nationals lists that appear courtesy of the U.S. Treasury. With regard to Bitcoin and digital currencies, it's global. So what most financial institutions do and money service businesses do, they actually take on and screen against more lists than just what the U.S. Treasury provides. They look at lists from Palestinian lists, they look in Canada, they look in Europe, they look in Asia, routinely trying to identify anybody that may appear on these illicit lists that include narco-traffickers, terrorists, et cetera, et cetera. Again, that is part of a robust anti-money laundering program. The program is critical that it is not a template. It is critical that it is not a sort of set it and forget it operation. It's actually an ongoing life cycle that a regulated financial institution or money service business needs to maintain on a routine basis. There needs to be a risk assessment associated with that so you understand what the risks are associated with the products or services you're actually delivering or servicing in the marketplace. Oftentimes, these are sort of pain points that have been identified in failures at money service businesses as well as banks, even banks here in the state of New Jersey. More to the point about classification, where digital currency at this point in time, based on FinCEN's interpretive guidance in 2013, we have a situation where it's currently considered at the federal level as a money service business. Money service business in the banking sector is considered by the Foreign Financial Institutions Examination Council, which is made up of all the banking organizations at the federal level. They release a manual, and it's called the BSA AML manual. And there's also one specifically tailored for the MSB population. The one specifically for the financial institutions actually classifies that money service businesses may be of higher risk, meaning that it puts a burden on the financial institution to do either due diligence or enhanced due diligence on a money service business, meaning there's more data collection, there's more monitoring, et cetera, et cetera. These are seen as some of the riskiest customers inside of a financial institution. They are also the first customers typically exited from a financial institution based on regulatory examination, that a financial institution may not be mitigating its risk appropriately. So digital currency, while it's at its infancy, has come across with a significant amount of negativity through Mt. Gox, through Silk Road, through the Charlie Shrem case. You have a situation where the financial institutions are looking at this not only as a high-risk product, a highly volatile product that they do not currently understand. Financial institutions are gaining a significant amount of knowledge, but in order for a financial institution to take on a digital currency company, not one that's not engaged in money transmission, one that's clearly engaged in money transmission at the federal level, they're also required to identify whether or not a money transmitter license is applicable at the state level. The financial institution is charged with actually providing that and documenting whether that company, whether it could be a check casher or a traditional remittance business, actually maintains a license in that state. During the examination period, the financial institution has to prove through that due diligence process that they've obtained that documentation and that their client is compliant. With regard right now to a number of jurisdictions in the United States, a number of them have not gone ahead and performed or provided any sort of guidance with regard to digital currency companies falling under money transmission laws. So where financial institutions are willing or actively seeking to bank digital currency companies, there's a little bit of a friction point where they need to overcome that hurdle of, is the company in fact a money transmitter? We've heard from ItBit earlier who says they're not in the United States for the sole reason that they don't have the money transmission licenses in the jurisdictions. Until that happens, there's going to be a continuous aspect in the financial institution environment that several things are going to happen. One, There are going to be companies that achieve the appropriate level of state licensing, and then therefore they will get banked if they meet the additional requirements that a financial institution may place on them above and beyond the AML implications. 2, digital currency companies are going to effectively perform a Mt. Gox. They're going to state at the point of onboarding that they're not a money service business, and they're going to operate within that financial institution. And the financial institution is going to be charged through its transaction monitoring process of identifying whether that entity is actually operating as an unlicensed or unregistered money service business. The third aspect is actually something similar that was stated earlier, that a jurisdiction or a state can go ahead and identify that currently the operating model, the transmission laws for the state do not apply for the digital currency business model that's put before them. That documentation will then be used by the financial institution as sort of part of its due diligence process in determining whether or not they're going to bank a digital currency company. The amount of digital currency companies that are operating knowingly by financial institutions in the United States is relatively less than 10. And they are not by the global financial institutions that we are well aware of. More tech-oriented financial institutions, mainly for the reasons which I've stated. Banks are in a situation currently right now where the money service business portfolio is in a little bit of attack being exited due to risk profiles across the long-standing relationship of the financial institution and its other customers. If a financial institution needs to mitigate its risk, they'll very easily, typically, push out the money service remittance portfolio. Because inclusive of that happens to be border banking, international remittance transfer, check cashers. From a compliance perspective, these customers are very operationally compliance heavy, require a lot of systems, a lot of resources, a lot of expertise on knowing what the actual transaction activity looks like in order to properly meet your federal obligation to file suspicious activity reports. So I'll leave it to the panel.
Any questions? Thank you very much for your testimony. Thanks for coming down. We appreciate your time. Quentin Page. Good afternoon, Mr. Page.
Good afternoon. Yeah, I'm Quentin Page. I'm the general counsel for Coinware. Coinware is the parent organization of an affiliate group of corporations involved in customized software solutions for the digital currency environment, contract mining, and turnkey consumer mining solutions for consumers who want to get into the Bitcoin mining market but don't have a lot of technical expertise or large amounts of capital to do so. I have to apologize in advance. My thoughts were much better organized before I got here. But unfortunately, a lot of the points I wanted to make have already been made, and a lot of new items have come up. So please bear with me. I will, of course, respect your request not to simply read a prepared statement. The first issue that was on that seems to have been of greatest interest is what are the risks and benefits to consumers? The risks are small, manageable, and I think shrinking. Obviously, there are risks of fraud, there are risks of theft, but the biggest risk right now as it exists for consumers in the state of New Jersey is fundamentally a lack of understanding. Most people do not know what Bitcoins are. They do not know how to treat their wallets. They don't know how to secure them properly. They don't know who the reputable players are, these sort of things. Fundamentally, the answer to this is going to be in the form of education. Right now, the average consumer, if they want to find out something about Bitcoins, they're going to go on Google. Unfortunately, on the Internet, there are a lot of people saying a lot of things. Some of them are reputable. Some of them are well-informed. Many of them are not. Certainly, this is where some place like the state of New Jersey can bring tremendous benefit to the table, because as somebody who's recognizable, reputable, authoritative, you could provide, the state could, through any number of agencies, through any number of initiatives, provide at least a source or the beginning of a source of reputable, reliable information for consumers on how to interact with this new community and this new technology. The benefits to consumers, I think, to some extent have already been addressed pretty thoroughly. There's lower transaction costs, there's greater convenience, there's greater personal control over your finances. There's also a significant portion of New Jerseyans who are what would be called unbanked. They pay substantial fees to check cashing agencies, et cetera, who do not have access to other financial instruments. And Bitcoins could provide at least a partial solution to that consideration. The other big benefit is, and I think this has been discussed in some extent, is the protection against identity theft. Certainly, you can't open a newspaper without hearing about a news story about consumers' information being hacked, people's credit cards. There are services on the internet whose entire reason is to try to protect you from identity theft. I think the analogy that's been given about Bitcoins being essentially like cash is an apt one. Certainly, if you have a choice between paying somebody by check and paying somebody by cash, the level and the extent to which you've exposed yourself to risk is dramatically different. You give somebody a check, they have your name, your address, your telephone number, your bank account number, and as anybody who's ever received an email from a Nigerian prince knows, these are certainly issues that's certainly information some people want to get a hold of. Whereas if you hand somebody a $20 bill, they know nothing except that you've paid. So there are those very obvious benefits. There are, however, some areas where I think consumer safety and consumer protection could also be enhanced by the actions of the state. Certainly, clarifications of criminal codes, civil codes, to simply recognize that these Bitcoins are things of value and what sort of protections. When you hack somebody's Bitcoin wallet and if you take it, is it theft of data or is it actually theft of property or theft of currency? I'm not sure to the extent to which these matters have been decided, but certainly a consumer would probably like to know what level of protection they have, and certainly businesses would as well. The state of New Jersey, I think, could also be very effective in encouraging the development of best practices within the industry. I also think in terms of enforcement, the development of a joint enforcement agency Bitcoin industry task force to identify not just the existing ones, but the emerging threats to the industry, to consumers, and to the financial security of the entire transactional system would probably be quite beneficial. The minimization of illegal activities or illegitimate activities online, I think one of the key concepts to recognize here is that as anybody who's ever gardened knows, one of the greatest defenses against weeds is having a healthy and vibrant garden itself. So I think one of the keys is going to be on focusing on encouraging, enhancing, and helping the legitimate portion of the Bitcoin industry grow and mature. These industries, as they become valuable in their own right, as they have a great deal to lose, they tend to become self-policing and tend to become considerably less tolerant of bad actors generally operating within their space. I don't think he still is here, but certainly Assemblyman Off asked the question about pyramid schemes, and there was also the question about whether or not the price volatility that was demonstrated back at the end of 2000, whether or not that was indicative of something nefarious or manipulative going on. In response to that, I think people have talked about things like Bitcoins are small, et cetera, et cetera. Just to throw some numbers out there, right now, the market capitalization of the Bitcoin market is probably at about $3.8 billion, and there's about $50 million a day on average transacted on the Bitcoin network. As you can see, if you compare that to the size of the capital markets as they exist generally in the world, it would take a very small shift in capital from some existing market, from banking, finance, from simply the liquid cash that flows through the financial systems, to create dramatic swings in the demand and supply, the relative supply and demand of Bitcoins, with their corresponding changes in price. This, fortunately, is one of the easiest things to fix. As Bitcoins increase in acceptance and they increase in consumer use, as the market grows larger, as the daily transaction volume grows larger, the ability of any single event to cause substantial fluctuations in the price diminishes, but also, more importantly, the ability of any bad actor to deliberately cause any manipulations in the price of the Bitcoin also drops. And of course, I think that's probably going to be a matter of great interest to people who are investing in secondary financial instruments like derivatives, which are, of course, very subject to fluctuations in the price of Bitcoins. So then, how is it that State of New Jersey or any regulatory body can assist in growing the legitimate uses of Bitcoins? Certainly, you can lead by example. Acceptance of bitcoins for certain things, even starting small. The Port Authority allowing bitcoins to be used for Easy Pass, for paying tolls, these sort of things. It establishes a pattern of officiality and acceptance to the bitcoins, which would, of course, I think, rub off on the market generally. In the event that you are able to eventually establish a set of best practices, certainly safe harbor provisions in regulatory codes could be of tremendous benefit for companies looking to relocate and to do operations in here. People have already mentioned the very obvious and significant synergy that would exist between a fully electronic bearer bond instrument like a Bitcoin and online casino gambling. Certainly it can help reduce the velocity of the transactions and the marginal transaction cost, which can only benefit both the gaming industry and the revenues the state of New Jersey derives from it. Certainly the issue of regulatory clarity has been discussed at great length, and I agree with that. There are a number of new emerging uses for the Bitcoins, but also areas where Bitcoins are seeking to emulate existing financial instruments, secondary financial instruments, exchanges, Bitcoin banks that simply don't deal in U.S. currency or any fiat currency, but simply exist in banks. Whether or not such banks can be given charters in a state. By the way, there was a question before about whether or not these exchanges and whether these Bitcoin entities are insured by some entity like the FDIC, et cetera. I'm going to back up a little bit and discuss the Mt. Gox issue just at a very high level to sort of explain the differences I see about these two things. And that is that Mt. Gox would probably be, the best analogy would be to a Wells Fargo in the days of the Old West. Somebody got into the safe and took the dollars out of the safe, and that caused the bank to go belly up. But that was not an indictment of the dollars in the safe. That was an indictment of the security system that was guarding those dollars. When you talk about insurance for existing Bitcoin firms, they're actually focused on event insurance, basically insuring against a theft, a loss, these sort of things. Insurance like the FDIC, that's an entirely different matter because there you're talking about fractional reserve banking, where it is the open secret that when you deposit money on to your bank account, even though they say that they have $1,000 of your money, in point of fact they don't have it, but they expect that they will get it in the event that you need it from whoever it is that owes the money. So most of the Bitcoin firms are not in need of the sort of insurance and oversight like you would discuss with the FDIC that was appropriate to fractional reserves. They're simply it's more appropriately that they be insured against single events or losses. So we were discussing the abilities, the ways that you could grow these things, finally, another area where the state of New Jersey could substantially benefit both itself and the Bitcoin industry and help to ensure the growth of legitimate industries is the possibility of creating things like enterprise cooperatives with either the state or with the municipality, where the authority and the trust established with a major municipality or the state of New Jersey could be used and could be subject to state auditing control for companies to become partnered with this cooperative entity so that other people, consumers who wanted to, for instance, get into the production side of things, who wanted to be miners, who wanted to have some stake in the growth and development of the Bitcoin industry, could do so with an element of trust that somebody they know, somebody who is reputable, is actually managing the important components of it. And then, lastly, there are a lot of benefits to the state of New Jersey. I think many of these have been discussed. There are a number of programs that are administered by the state of New Jersey, SNAP, Aid to Families with Dependent Children, et cetera, who each one of these programs spends a considerable amount of money every year simply on transactional fees. Obviously, any technology that can eliminate even by a percentage those transactional fees could ultimately save the state a considerable amount of money. The state of New Jersey also pays a fair amount of money to credit card companies for processing payments on their behalf. You go to the New Jersey Motor Vehicles Commission or any number one of the places that you pay fees to. Once again, the state of New Jersey is paying Visa, MasterCard, or some bank who's operating as their proxy, probably, when you add it up, millions of dollars a year. final bit that I would like to comment on here is that and I think Marco alluded to this quite effectively. This is this is an emerging technology. It's a high-tech industry. It's a high-paying field. The companies that will move here, if things are done well, and if we create a market-based, pro-business environment for these companies to operate on, it's going to create a large number of sustainable, permanent, living wage jobs. But the other thing, and this is the intangible benefit, is you're going to create a nucleus of a high-tech community. Think Silicon Valley East. We may not know what this group of technically savvy entrepreneurs is going to create in the future, but you know without question that it's going to create something. It's going to create something very valuable. And that's the gist of my prepared comments.
Well, thank you very much for that, and thank you for sticking around so long. So we're losing our audience a little bit. But thank you very much. Anybody have any questions? No? Okay. Thank you very much. We appreciate your time. And for the last word, Professor Shadab. Somebody had to go last, Professor.
Hi, my name is Professor Houman Shadab. I'm a professor at New York Law School, and I'd like to thank the chairman and the committee for having me here, and thank you so much for giving me the last word on these issues here. So I just want to quickly just discuss the state-level issues, talk about some principles, and make pretty much, I think, a recommendation for you about how I think is best to proceed forward. And one really is, like many others said, to embrace innovation, but not just for its own sake, but to embrace innovation that does serve the public interest. So not only are new technologies making things faster, cheaper for consumers, there are ways for example, people to use Bitcoin in many respects for public interest or humanitarian purposes. So one is a market for remittances, transferring money basically back home to your family overseas. Right now it's in excess of a $435 billion market globally, where typically people are charged on average 8% fees. Bitcoin can reduce those fees and make them almost negligible, and allowing people to transfer money maybe in the country or within countries and certainly abroad to developing nations at a much cheaper rate. In terms of public interest, Bitcoin, believe it or not, it can actually be a way for regulators and state authorities and law enforcement officials to do their job much better. And I think actually in a non-intuitive way that the recent case against the Silk Road and Ross Ulbricht and the so-called Dread Pirate Roberts, where they were buying illicit goods and activities online, and people associated Bitcoin with that type of illicit activity in a negative way. In a sense, it should be a positive way, because the Bitcoin transactions that were found ultimately through relatively traditional law enforcement methods were used to prove the case against him. Because Bitcoin creates this sort of irreversible, non-corruptible transaction record that once they get the basic information and some of the laptops and so forth that was involved, they can't be changed or manipulated, and they provide essentially proof of identity in that respect. And so in terms of what the choices I think that any particular state has in front of them, it's either keep things how they are, move maybe in a brand new direction like New York did, or maybe just clarify how existing laws apply to the state level regulation, and particularly, of course, money transmitters. I recommend that this state and any state doesn't go in the direction that New York did. I think New York was very thoughtful. I think they understand the technology, they appreciate the entrepreneurship, they appreciate the investment and the human and intellectual capital and the potential of digital currencies. But the problem with creating a new regime is that it's technology-based, and is that it creates a fragmented network of separate, different virtual currency state-level regimes from state to state. Right now, the Conference on State Bank Supervisors is trying to get together, as you may know, work with them or may have heard of them, and to make uniform across the states licensing requirements and licensing examinations, including between federal and state officials for anti-money laundering purposes. And I think that creating a new regime for virtual currencies essentially undermines that process and undermines that purpose and the integrity and efficiency that comes along with it. So that would be a problem with passing a uniquely tailored virtual currency transmitter regime. And just taking a step back here, it's important just to distinguish between virtual currencies or digital currencies as software, as applications, as new and better ways to do things we've never perhaps thought of before, and then the one use case of digital currencies as essentially exchanges and transmissions. And that maybe would require the application of a traditional state money transmitter statute, but clarified. Let's say that, hey, if you transmit digital currency or if you exchange it to real currency, that will qualify as an exchange or somehow be caught up in the regulations. Maybe that's a type of money for our statutes and so forth, essentially following the lead of what FinCEN did. FinCEN, the Treasury Department, the federal government didn't pass a brand new money laundering statute that just applies to virtual currencies. FinCEN came out with guidance in the past couple of years and just said, hey, you know what, there's this category of instruments, they're software, they're digital, we call them virtual currencies, and they're going to be currency for our purposes, and the laws are going to apply basically the same. And FinCEN, I think, is rigorous. Their oversight is strong, and they don't let things fall through the cracks. Lots of companies have been trying to gain exemptions, actually, under FinCEN, and they've said no in the two most recent cases that I'm aware of. They said, actually, these digital currency companies, our laws apply to you as well. And just the last point I want to make here is to appreciate that the Bitcoin economy, the digital currency economy, it still is a startup economy. In many ways it's fragile, in many ways it's small, in many ways it's very sensitive to overregulation, like any other community of small business people would be. So with that being said, I would like to, again, thank you for having me here and be happy to answer any questions.
Assemblywoman Caridi.
I've got one question.
Sure.
And it's probably like naive, and maybe it was said and I didn't hear it, but who started the Bitcoins? How did it get, I mean, it just seems like it came out of nowhere and people buy it, but who was the one that came up with that idea and said, hey, let's put this out on the web?
Yeah, the answer is no one knows. A person, perhaps fittingly with a pseudonym, Satoshi Nakamoto, a person or group of persons started the technology, essentially releasing a white paper and establishing a code that's sort of out there in open source, and people started using it. But no one knows. People suspect certain others, but no one knows who the true identity of the person is. But nonetheless, though, we do know the code, we do know those principles. That's sort of out there. It's public. It's verifiable. There's nothing secretive about the actual technology apart from the founder itself.
Any questions? No? Thank you very much.
Thank you.
Thank you very much for your testimony. Thank everybody for coming and for hanging in there. It certainly was wonderfully informative and given us an awful lot to think about. I appreciate everybody's being as succinct and as thorough at the same time as possible. I think in terms of next steps, I think there actually are some people who wanted to testify. We didn't have, believe it or not, we actually cut the list. So we'll see whether we're going to have any more hearings. But I think that probably this lends itself to sort of a roundtable discussion among members to kind of hone in on where we think we ought to be. And I would be surprised if many of the things that we learned here today weren't included in that discussion in a real way, and probably in a solution or a regulatory scheme. And so we may be calling on you to help us with that process. And we won't be shy about that. So thanks, everybody, for coming. Enjoy the rest of your day. Arrive home safely. Thanks very much. Meeting is adjourned.